So it's now Augustine, help us with the question 6. We know who the parent is. Can you tell us the parent from the question?
Choco.
Okay. So after knowing the parent, what do we do?
Put down our structure.
Okay. So we put our structure. We put our structure there. We put our structure there. Okay. So Choco consolidated statement of financial position. So what's the first item?
Non-current asset.
Okay. So you have the non-current assets. So the way the statement is being prepared, you also prepare it like that. So if they didn't put the non-current asset there, they just put asset there. Just do it the way they have done it. Don't say you are coming to separate it as non-current and current assets. If they put them together, you to put them together like that. Okay. So let's pick them one by one. Let me also be. So okay. So Choco, the so non-current asset, we have tangible assets.
Hello, sir.
Yes, yeah.
Hello, sir. Is the first thing, is it on the page?
Yeah,
The
we are
Choco and the...
we are using yesterday's one. Do you have yesterday's one?
Oh, okay. Okay. All right.
So the question 6 on the yesterday's own document. So we have 3690. So the investment in the MAM will be okay. The two investments over there are the investments in the respective subsidiaries. So you can ignore that one, and you can ignore that one and move on. So you have goodwill. Then maybe you can leave some space. Then you have current assets. Okay. So the current assets, we have the inventory. The inventory, that of the parents, is how much? 1050. Subsidiary, you have the receivables. The receivables is how much?
750.
Hey, the receivables is 570.
Okay, 570.
Okay. Then we have bank. Bank to be 270. Then we have equity and liabilities. Okay, so the equity, we have the share capital for the parents. Share capital for the parents is 5,400. Retained earnings will be that of the parents. Retained earnings for the parents, we do workings for it. Other components of equity, the parent is not having any, but the parent will have the share of other people's own that will go to other components of equity for the parents. Okay, so another one, we have non-controlling interest. Then we have non-current liabilities. Non-current liabilities is how much?
405.
Okay, that is 405. Their current liabilities is what?
300.
Okay, 300. So the next thing is that you would now take the footnotes to know the other subsidiaries. Take the footnote to identify other subsidiaries. So you can, from this place, you can just move on to your workings. You put your group structure here. We all know how to now put a group structure. So you put your group structure here. And the next workings will be your net assets. The net assets. Then the net assets, you now determine the subsidiary. You put acquisition here. And you put the reporting here. Okay. Then let's now take the footnote one by one to identify the respective subsidiaries. Let's take the first one.
Okay. Footnote A. Choco had acquired 80% of the ordinary shares of Mamobi on July 1, 2018, when the retained earnings of Mamobi stood at 300 million. The fair value of the non-controlling interest was 462 million at acquisition. The fair value of the net asset of Mamobi was 2130 million at that date. Any fair value adjustment related to inventory, and these were realized by the current year end. There has been no new issue of shares in the group since the current group structure was created.
Okay. Even if this was not mentioned, we assume that there will not be any new issue of what? Equity shares, because we want the percentage holding to be the same. Are we okay? All right. So what they are saying is that Choco had acquired what? 80% of what? Mamobi. So we are able to identify the first subsidiary, isn't it? All right.
Yes.
What you do is you go scan through and see whether there is any disposal in the subsidiary. So you can scan through the footnote to see whether there were any disposal. From my point, I can see that there were no disposal of what? Of equity shares in what? In Mamobi. So after getting this particular one, then you can go and now what? Add their figures to their parent own. So what is their tangible assets?
1,515 million.
Okay. Their inventory is what?
405.
405. Okay. 57. Their trade receivables is what?
315.
315. Their bank is what?
150.
150. Okay. So let's come to, you see that. No, there's no disposal. There's no disposal in the question. We don't have any disposal, or there's any disposal there. Do you have any question with disposal?
Yeah, I want to find out if there was a disposal, how we have.
Okay, if there's a disposal, you first of all ask yourself whether the disposal is leading to a loss of control. Is the parent now having, if you are disposing part of the equity shares, the question now is what is the remaining shareholding of the parent in the subsidiary? Is it less than 50? If it is less than 50, it means that the parent has lost control and they cannot consolidate the subsidiary again. So there will not be any consolidation of that particular subsidiary. However, you will now account for the remaining interest, which is the remaining what portion of the shares, which can be 30%, 20%, 40%. You account for it as either investment in associate or maybe a mere financial instrument if it is less than 20%. If the remaining percentage holding is less than 50%, it means that the parent is now having control. It's now losing the control of the subsidiary. Therefore, the parent has to calculate a gain on the disposal. So we calculate a gain on the disposal and account for the remaining interest as either investment in associate or a mere financial assets, which is going to be accounted for under the provisions of financial instruments. But if the parent dispose maybe at least 10% and they are still having remaining percentage holding, that is more than 50%, they still have control. So they have to consolidate. We don't calculate the disposal, but we assume that the transaction is between the NCI and the parents. So we just find a difference and send a difference to the other components of equity. So you only stop consolidating when there's no control. So if after getting the percentage holding, just count through and see whether the parent has disposed any of their shareholding in the subsidiary. Would a disposal lead to a loss in a percentage holding that would be less than 50%? If yes, then you can't consolidate again. So that is all about that one. Senior, I hope I've answered your question.
Yes, sir.
Okay. So let's come to their non-current asset. What is their non-current asset? What is their non-current asset?
75.
75.
Okay. Please, let's all try to participate so that we feel involved. Okay. So the current liabilities is what?
210.
Okay, 210. Okay. After getting access to this particular information, what is the next thing that you have to move on to? The footnote A. What are the things that you can do with the footnote A?
Net asset.
Okay, so we can now go and set their net asset. So the net asset will be, it will start with the share capital. So the share capital, you calculate the share capital from the statement of financial position before you compare with what was given to you. So you prepare the financial statement or the statement of or the net asset from the perspective of the financial statement. What is the equity value in the statement of financial position? What is the equity value? The share capital is what for them?
1,800.
Okay, 1,800. The same thing will be at reporting, isn't it?
Yes.
Okay, what is their retained earnings at acquisition?
300.
300.
Okay, I hope they have given that one to us in the footnotes. Okay,
Yes.
Yes.
reporting is what?
600.
600.
600.
Okay, so there's a post-acquisition profit of 300 if there is no post-acquisition adjustment. Okay, let's now count to, did they have other components of equity?
No.
Okay, you see, sometimes the question can give you other components of equity at the beginning. But if you look at the statement of financial position, they don't have any other component of equity at reporting. So they can say that their other component of equity at acquisition was 10. Okay, they will say that it was 10 at acquisition, but at reporting it will be dash. What is the meaning of that?
Come again.
Okay, at acquisition they can give you 10. At
Okay.
acquisition they can say that they have other components of equity as 10, but reporting they will
Okay.
give you dash. What is the meaning of that?
Okay, maybe there was revaluation surplus and later on there was an impairment loss which was reversed through the revaluation surplus.
Okay, okay. So the meaning is that there was a loss during the post-acquisition period. That is making the opening balance to be 0. Are you okay?
Okay.
So if your post-acquisition profits, in total is 200, okay. If you have subtracted the reporting and also the acquisition, you have gotten 200 as a total. It means that the profit made for the year was actually 210 because the loss for the year has reduced this particular 210 to 200. That's why we are getting the difference over there. So you gross the profit to be 210, then you share the profit and come and share the revaluation loss or the loss of 10. That's how that's how you go about it. Okay. It's not anything. Let's move on. Let's move on. So they don't have any other components of it. Let's see whether they have any fair value adjustments. Is there any fair value adjustment?
It says any fair value adjustments recorded related to inventory, and these were realized by the current year end.
Okay.
There has been no new issue of shares in the group.
Okay. So that is the only movement in the what? The only movement in the fair value will be that particular one, isn't it? Okay.
Yes.
What's supposed to be our what figure or what amount supposed to be the net asset? Based on the calculation that we have done, what should have been the net asset at acquisition?
2001.
Okay, but what are they giving to us?
2,130.
Okay, so it means that they are saying that the difference over there should be relating to inventory, isn't it?
Okay.
Okay, so the inventory will be 30, isn't it?
Okay.
So we are going to be having 2130 over here. They said the inventory has been realized at the current year end.
So
It
please
means,
come again.
okay,
I don't know.
they have given you the net asset value, isn't it? Okay, they have given you the net asset value, the fair value of the net assets to be 22,130. But first of all, you have to calculate your own net assets from the statement of financial position, which will be the share capital 1,800 plus the retained earnings 300. So from your statement of financial position, your net assets should be 2,100 if there is no fair value adjustment. But they have now given you 2,130. It means that the net asset that you have has now increased by 30. And they say that the difference should be relating to inventory. So the 30 is for inventory. Are we okay?
Yes.
Okay.
Thank you.
But do we have any inventory? Do we have any of this inventory at the current year end? Do you have any of this inventory at the current year end? The inventory that was revalued, do we have any of them at the current year end?
Yes.
Read that part again. And these were realized by the current year end. It means that they have been sold. So none of this inventory will be at what? Reporting. All of them has been sold during the year. So the reporting, there will be dash. None of the inventory is left. Sometimes a question will tell you that 30% of them is left. You just find a 30% of the 30, and that will be the balance at the closing. Then you also go and add it to the inventory. They are saying that all of them has been realized. They have been sold. So we don't have any of this inventory in our stock at the current year end. So the reporting will be dash. Reporting will be dash. So let's now come to this particular. What is the difference at reporting? So we have 2,400 against 2,130. What is the post-acquisition profit?
270.
270. So this will be shared among the NCI and then the subsidiary. Okay. Are we giving the NCI figure?
If we close it, what if there are intergroup transactions?
Okay. Okay. Sorry. So let me leave this place for now. Okay, thank you. There might be intra-group transactions, so let me leave that place for now. Okay. But from that place, I can move on to goodwill. Okay. I can move on to goodwill. So I can move on to goodwill calculation for Mamobi. So that we have the purchase consideration. What is the purchase consideration paid for the shares? What is the purchase consideration paid for the shares?
Is 1920?
Yeah, 1920. Okay. So that will be, though the question you haven't mentioned it, but that is the investment in Mamobi. So that is the value that the parent has paid for the shares. What do we do next? We add what? The NCI, because they are the fair value of the NCI. So what is the fair value of the NCI there?
462.
Okay, 462. So if you add the two, what are we having?
Hello, sir. Please, which line is the purchase consideration? I can't locate it.
Go to the statement of financial position. Investments. You see Mamobi first and Tesano. Can you see that?
2382.
Okay. 2, 3.
Yes, sir. Thank you.
Okay. So the net asset is what? 2130. What is the difference?
252.
Okay. 252. Okay. The next thing that we can move on to is, let's count to, okay, we do the calculation of goodwill for the two. So let's count to NCI. So the NCI, let's count to the NCI. The NCI will be for that of Mamobi. Okay. The Mamobi, we are going to be having the fair value of the NCI at acquisition to be 462. Okay. So we have utilized the footnote A to get plenty ticks. We have utilized the footnote A to get what? Plenty what? Ticks. That is all. So we don't have to use the footnote A for anything again. The group structure, we have already done the group structure. You know how to do the group structure, and also the acquisition date. You write the acquisition date there and all those things. Let's come to the B.
Choco and Mamobi had acquired their holdings in Tesano on the same date as part of attempt to max the true ownership of Tesano. Choco acquired 40% and Mamobi acquired 25% of the ordinary shares of Tesano on 1st July 2019. The fair value of the non-controlling interest in Tesano was 447 million Ghana cedi at acquisition. The retained earnings balance of Tesano on that day was 150 million, and that of Mamobi was 450 million. There was no revaluation reserve in the books of Tesano at acquisition. The fair values of the net asset of Tesano at acquisition were not materially different from the book values.
Okay. What is happening over here? You can see that Choco and the parent and the subsidiary, they are both buying what? Or they are both making investments in what? In the Tesano, isn't it?
Yes.
Okay. You can see that the parent is having what? The parent
40%.
is having 40.
Direct.
Okay. It's having a direct of what? 40%, isn't it?
Yes.
And the subsidiary is having what?
25%.
If you put the two together, they have control, isn't it?
Yes.
Because the parent is being owned, the subsidiary is being owned by the parent. So you can see they are indirectly, they are having what? Control. Okay. But the 25% is for the what? Is for the main subsidiary, which is the Mamobi. What will be the parent's what? Share of that particular 25%. So we now look at what we call the indirect what? The indirect
control.
Yeah, the indirect control, or the, so let's
Indirect shareholdings.
Okay. So let's look at the parent itself. So the group structure, let me put it over here now. Okay. Okay. So the group structure, we have the Choco. So we have the 80% in Mamobi. Then we have Choco again. Then we now find the what? The parent what? Interest in the in the subsidiary. So it will be 40% plus 80% times 25%. Do you agree?
Yes.
Okay. So it means that the parent will be having 80% of the 25%. Any profit that will come from Tesano. The Mamobi will be taking 25, and that 25 will be shared among the parents and then the NCR. So the parent will be having 80% of it, then the NCR will be having 20% of it. So in all, what will be the total of the parent shareholding in the Tesano? That will be what? If you add a 2,
60%.
okay, so we are having 60%. So it means that we can start consolidating them also. So let's go and put their assets also together now. So we can start consolidating them. So let's go and start the consolidation of their figures because we are having a control over them. Okay, so what is their tangible asset?
$768.
Okay, their inventory is what?
147.
147. Okay, their receivables is what?
240. Oh,
The receivables is
no,
together with the
inventory is 195.
Inventory is 195.
195.
Okay, and the
Receivables is 147.
147, yes.
and the cash is what? 240.
240.
Yes.
Okay. Their current liabilities is what?
It's 150.
Okay. And the non-current is what?
60.
60.
Okay. Okay. So from this particular one, we can also go and put their net assets.
Sir,
over
please,
there.
sorry for drawing you back.
Okay.
I'm back. I had a network challenge. Please, why are we adding the Tesano figures to it?
The Tesano, the parent is not a subsidiary. Tesano is now a subsidiary from the B.
Okay.
Okay. Senior, which suggestion are you talking about? If you can come, someone was putting a suggestion there. If you can make it clear. So from this one, we can now put their net asset also there, isn't it? Okay. So let's pick their net assets. The net asset for Tesano. So we have the reporting. So let's take their share capital. What is their share capital there? The share capital for them is what?
750.
750. Okay. And that will be 750 again. The retained earnings is what? Yeah, Auntie Dinah, this is how we get the 60%. The parent itself is having 40%. Okay, so that is a direct interest, which is the parent itself is having 40% in the Tesano. Okay, but a subsidiary, which is the Mamobi, is having 25% over there. So whatever profit that will be coming in Tesano, the parent will be having 80% of the 25% that Mamobi will be having. So what is the parent's share of the profit that Mamobi will be having from the subsidiary? that will be the 80 of the 25% share. That will be 80% times the 25. And that will give us 20%. Then you add the 20% to the parent's own interest that they have of 40%. So the parent is having 20% from the subsidiary, which is Mamobi, and the parent is having 40% interest on its own. So if you put the two together, that will give you the 60%. Okay. So let's now come to their retained earnings at acquisition. What is the retained earnings at acquisition?
Hello, Linus.
Yes, senior.
Hello, Linus.
Yes, senior.
Please let me chip this in. I want to ask a question. In case maybe Choco did not have any 40% holding in Tesano.
Yeah.
And then this Mamobi had the 25%.
They will be treated
What
as
would have been the situation?
it will be treated as investment in associates.
Okay.
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 So
All right,
it will be
thank
treated
you.
as investment in associates, where the 25% that will be coming from that place, the parents will now be having the share of what?
The
Of
80%.
The parents will be having 80% of the 25% that will be coming there.
Okay.
Okay. So
All right,
it will
thank
just be
you.
treated as investments in associates.
Associate.
Investments.
Okay.
All right.
Thank you.
All right. So the retained earnings at reporting is what? For them is 180. Okay. Do they have other components of equity at acquisition?
At acquisition, no. At reporting, yes.
Okay. So the retained earnings balance of Tesano on that date was 150 and Mamobi was 450. Okay. There was no revaluation reserve in the books of Tesano at acquisition. There was no revaluation reserve. The question has stated it, isn't it? Okay. So other component of equity. The other component of equity is dash for them. And how much at what acquisition? 210.
210.
Okay. 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 You see what the question that they are giving that Mamobi's return earnings that they are giving to you is not relevant. It's not relevant. Okay. Because we are not interested in what is the profit. No, we are not interested in that particular one. So what they are giving to you is not relevant. It will only be relevant if there is any issue of disposal or any issue of something over there. If there's any transaction, then we'll be able to determine that particular item. So the return earnings of Mamobi is not relevant in that particular situation. So they are saying that the fair value of the net asset of Tesano at acquisition were not materially different from the book value. So the book value are the same as what? The fair value. There's no fair value movement. But what is happening over here? We also have the NCI. They have given you the NCI, isn't it?
Yes.
Okay. The NCI, you add the two values. You do the calculation for them together. So Mamobi, we have the Tesano. So what is the NCI for the company there?
447.
447. Okay. The NCI figure that they are giving to you over there is 40%. Is 40% because you can see that indirectly the parent is having 60%. So the remaining 40% is the 447. Sometimes the question can give you you see that if you add the two interests, the two holdings of the parent and the subsidiary, it will be 65. So the question will be giving you NCF for 35 and also NCF for 40. We always calculate the NCF for what? For the indirect what? Interest. That will be 40. So don't take the 35.
Okay.
Don't take the 35. You take the what? The indirect what? Interest of the NCR, which is the what? The balance for the NCR in the subsidiary itself, and also the NCR itself in the what? In the subsidiary. Okay. I will take that again. You see that whatever profit that Mamobi will be having from Texano, the NCR will be having what? 20%.
25.
NCR will be having 20%.
Oh, okay.
Okay. And that will give us 5%. Are we correct?
Yes.
Okay, so you see that the NCI in Mamobi is also having 5% in what? In Tesano. But in Tesano itself, there's an NCI value of 35. So put the two together, you have your 40%. That is the reason why we always use the what? The indirect interest of the NCI. So we put the NCI, what is the NCI interest? The NCI interest of the subsidiary itself. What is the NCI interest in the sub-subsidiary? We add it to the what? The subsidiary's own NCI, which is the 35. So you have the 40. So we put the two of them together to have the 40. So they can give you the value for each of them one by one. Pick the indirect one. Okay. Let's come to that one. So the NCI over there is 447. Okay. Let's now go to goodwill calculation for these people. So we come to goodwill calculation for them. Goodwill for the sum. So the purchase consideration will be in two folds. The first one will be the parent own 40%, isn't it? Okay. So how much is the parent own 40% in Tesano?
480.
Okay, that is 480, isn't it? Okay. Plus, what is the 25% of the Mamobi in Tesano?
300.
But what is the share that the parent will be having from the interest in what? In the Tesano? That will be 80%, isn't it? The parent is having 80% of the 25%. Am I correct? So you only find 80% of that 300. The remaining 20% will be given to the NCI. So that particular 300 will be shared among the parents and then the NCI of the subsidiary itself. So the parent will only bear only 80% of this because the 25%, the parent is having only 80% of the 25%. The NCI will also be having 20%. So you just share it among them. So what will be the total purchase consideration?
720.
Okay. So 720. Then we now have the NCI. The NCI is what? 447.
447.
Okay. If we put the two together, what are we having?
1167.
Okay. Okay. You can see that there is no issue of fair value adjustment at acquisition. So we can just put their net asset together and come and find a goodwill over here. So what will be their total net assets for those people? Because there is no other issues there.
$900.
Okay. So the 900 is in it's 750 plus 180. Okay, sorry. 750 plus
So, but we
180.
are not done with the footnotes, or
The NCI, are we not supposed to add it?
The NCI.
The 460 and then the 447.
No, the NCI, the 462 is for Mamobi. We are only going to be using the NCI for what? For the Tesano. So we don't add the two we don't add the two MCS. This
We are doing
particular
them separate, right?
is that?
We are doing it separate, right?
Yeah, we are doing the goodwill calculation separately. We calculate the goodwill separately for each of them.
Okay.
Okay. Don't calculate the goodwill for all of them at once. You do it for them separately. Okay. So this will be 900. What is the difference?
$267.
267. Okay. So we are done with the footnote. The return earnings for Mamobi is irrelevant for this particular question. As far as this particular question is concerned, the return earnings for the Mamobi over there is irrelevant. Okay. Let's now go to the C. So we are done with the B also. There is no fair value adjustment. We don't have to add anything over there. So let's move on to a different issue. Okay. So let's look at the C.
Linus,
Yes, yeah.
please, my network went off small.
Okay.
Please, the purchase consideration for Tesano.
Yeah.
I'm seeing 480 plus 0.8 times 300.
Yeah, the 480 is the
Can you
parent
explain
paying
that?
40.
Okay.
The parent is having direct 480. So how much are they paying for that? That is the 480.
Okay.
But Mamobi has paid what 300 for the 25%. Okay.
Mhm.
Any interest that will be coming from the Tesano, the parent will be having only 80% of it.
Okay.
So it means that the 300 must be shared among the parent and then the NCI. So the parent will have 80% and the NCI will have. So let's come here. Share of the purchase consideration in Tesano. This will be reducing their NCI. So let's do that one step so that we know
Mhm.
forget.
Okay.
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 So 0.2 times 300. Okay, that will be 60. That will be because the NCA will not be paying. The NCA will not pay for it. So we have to take it from their investment that they have. They are not bringing cash for this particular figure. So we just take it. But if they say the NCA has already paid for this, then you don't do anything. You just leave it like that. Okay.
Okay.
Yes. So now I guess let's take the C.
So before Augustine comes, so
Okay.
Linus, what you are saying is that this 300, everything will be paid by Choco.
No. Choco will pay. What are they?
280.
They'll be paying 240. Okay. They'll be paying 240. Okay. Which the subsidiary is paying on their behalf. So the subsidiary has
Okay.
already paid. Okay. But the 60 have to be paid by the NCI. But the NCI
Okay.
they don't have to pay. So we just go and subtract it from their current holding that they have. So we reduce the current holding. That's all.
Okay.
All right. So let's look at the C then.
Linus,
Yes, Inya.
the system from the holding of Mamobi or Tesano.
It should be from Mamobi, but since we are putting the two together, that's how I've just subtracted it from them.
Okay.
Whatever be the case, do the NCA calculation together. You can put all of them together and just because you'll be totaling them and bringing them to that particular one. So you can just put them together and do the working. But it will be the Mamobi people that will be suffering the 60, not Tesano. Okay. Okay. See, let's move on.
Included in inventory
Okay.
is the reinstated process cost earlier expensed, recognized as development inventory. These costs do not meet the development criteria in IAS 38, intangible assets for classification as intangibles, and it's unlikely that the net cash inflows from these will be in excess of development cost. In the current year, Mamobi has included 60 million of the cost in inventory.
Okay, so what are they telling you? They are telling you that, you see, the inventory, included in the inventory is the what? Reinstated process cost earlier expense recognized as what? Development inventory. Okay, so in the inventory, there's some cost that has been earlier expensed, but they are now restating it. Okay, it's an inventory that they are developing, and we know that development cost, if the product is feasible, if management has the expertise or the resources to continue the product or the project, they can start capitalizing that particular development cost. That is 38. But they are saying that the development cost for this particular year has been how much? The development cost for this particular year, the current year is what?
60 million.
60 million. But this has not met what?
The criteria.
So it means that they should be expense for this particular year, isn't it?
Yes.
So, but they have been included in inventory. So we go and subtract it from inventory and now bring it as what? As an expense under the net asset. Okay.
The return. Okay.
Okay. So that will be under
Net asset for Mamobi.
Mamobi, yes.
Mamobi.
Yeah.
Oh, okay.
The return earnings is under the reporting. But if we are doing profit or loss, we just send the inventory to the statement. We just add it to cost of sales. If we are doing profit or loss, we just go and add it to cost of sales. But since we are doing the report, we are doing the statement of financial position, it means that the profit is always in the reporting figure. So we count to the development inventory over here. So we put dash here because this is for the current year. The current year will always be at what?
Reporting.
After
post.
acquisition. Okay.
Okay.
Because you can see that the Mamobi was acquired on 1st July 2018. But the reporting period is what 30th June 2021. So it means that this is post-acquisition. This will be 60 here. You take the 60, then you go to the statement of financial position and also take 60. I hope we are okay with that adjustment.
Okay.
All right. Let's move on to, okay, let me be showing the screen. And so that we'll be moving to the other one. Okay, so we are done with the C. That is the only thing over there. So if the criteria is not met, they can also, another way of telling this question is that they can give you an intangible. They can give you like intellectual property. They can give you like maybe brand. Okay. And they will say that this particular brand, the time that they acquired them, or maybe the brand has been acquired for a long time, or the intellectual property has been, they have a copyright on it, that they are at the time of doing the patent right or the copyright, they are sure that this particular copyright will give them a future cash flow in excess of the cost. So they have capitalized it. They can see that at acquisition, they have now realized that this particular patent right or the copyright can no longer give them a cash flow. It means that it should be written off at the date of what? Acquisition. It is now worthless at the date of acquisition. But what they will do is that they will tell you the what? The amortization that has been charged for the year. So they can give you the closing figure for the intellectual property. The intellectual property to be 45. Okay. Then they will say that at the date of acquisition, it has been noticed that this particular intellectual property is not going to give them any cash flow again. It means that at the date of acquisition, the intellectual property is worthless. But they will not give you the figure at the date of acquisition. They will give you the closing balance. Then they will give you the what? The amortization for the year, which is 5 million. So they will give you the amortization of the intellectual property for the year. So what should have been the figure at acquisition now relating to the intellectual property?
You multiply it by the post-acquisition years. You multiply the amortization by the post-acquisition years.
Assuming it is a full year. It's a full year and amortization for the full year is 5 million. So at the date of acquisition, what should have been the actual value of the intellectual property?
It's 50 million.
Okay, that would have been 50 million, isn't it? Okay, so at acquisition, you subtract 50, but at reporting, you subtract what? 45.
45.
Okay, so you have to be very mindful of these particular issues. They can do everything possible, and if you don't, the consolidation is about you understanding the footnote. It's very important, and you understanding the footnote, you just ask yourself who is suffering or the footnote is affecting who. If you know the company that the footnote is affecting, then you know how you are going to treat it. It's relating to who? That is the question. This particular footnote is relating to who? Then you have to adjust it against the persons, like the C. You ask yourself, who is doing this? It is Mamobi. So what should have been the correct treatment for this particular event? You just go and do the correct treatment for Mamobi. That is all. There's no big issue. There's no magic. Let's take the D.
Mamobi had purchased a significant amount of new production equipment earlier in the year. The cost before trade discount of this equipment was 150 million. The trade discount of 18 million was taken to the income statement. Depreciation is charged on the straight line basis over a 6-year period.
What are they talking about over here?
So there's a discount that should have been taken out of 150 to record the asset at 150 less 18. So right now the asset has been over stated by 18.
Okay.
And then this 18 has also gone into the P&L to the increase.
Yeah, it's treated as
increase,
income.
yeah, as an income.
Yeah.
So, and in that same vein too, we have overcharged depreciation.
Yeah.
So we have to go and add back the depreciation, take out 15 from current assets, and then go to their net assets and take out the 18.
That is all. This particular footnote is relating to which standard?
PP.
PP,
Yeah.
IAS 16.
Yes. So if it should be a cash discount, that one there, the cash discount can be taken maybe more than 3 times within a year. So that one you can treat it as an expense item. But if it is a trade discount, the trade discount should be taken from the purchase price of the assets. Then you now depreciate the assets. So it means that the actual treatment of this particular asset should have been 150 minus 18, isn't it?
Yes, 132.
And the difference should have been 132. So they say earlier in the year, so we assume that it's at the beginning of the year. Are you okay?
Okay.
Okay, it's earlier in the year. Since they haven't given us the date, we assume that it is what? It is a full year. Or the question can say that full year depreciation is charged in the year of acquisition and no depreciation in the year of disposal. So even if it is being bought 3 months to the reporting period, you still charge a full year depreciation. Okay. So the first thing that we have to do is that this should have been taken from what? From our
The PP.
PP. Okay. So we have to go and reverse the what? The discount that they have treated as what? As income. Okay. So they have treated the discount as what? Income. So the discount is Mamobi that is doing this. The discount received should be reversed. So reversing means that we take it from our income. Okay. So we are going to be debiting our retained earnings and crediting our assets. Is that correct? Okay. So the corresponding entry will be that because we assume that the asset is having a 150 over here. It shouldn't be 150. It should have been 150 minus what? 18. So we remove the 18 from the asset and also remove the what? The 18 from the retained earnings. In other words, we remove the 18 from the retained earnings and now send it to the asset and now do the correct treatment. So we have done that. Let's now look at the depreciation that has been charged and the depreciation that should have been charged. The depreciation that has been charged and the depreciation that should have been what? Charged. So let's look at the depreciation here. The depreciation that was charged was 150 divided by what? 6. How much was charged as depreciation? I'm having 25 million.
Yes.
Okay. What should have been the actual depreciation?
150 divided by 6.
Okay, it will be 132 divided by what? 6.
Three.
Okay, so what are we going to be having?
22.
We have 22, isn't it?
Yeah.
Okay. What is happening? Instead of them subtracting 22 from the retained earnings and also the what? The assets, they are subtracted 25, isn't it? Is that the case?
Yes.
Okay.
Yes.
So what do we do now? What will be the treatment?
We add it back.
Find a difference.
Okay, the difference is what?
3.
Okay. So the excess depreciation of 3 million. Okay. So they're supposed to charge 22 million, they have charged 25 million. How would this particular 3 million be charged? Be treated?
You add it back to the retained earnings
And also,
and also the PPE.
so we debit the asset, the PPE, and we credit what? The retained earnings.
earnings.
You can see that we have subtracted 25 from the PPE instead of 22. So let's go and reduce our 25 to 22, that is all. So you come to The return earnings, that is for Mamobi. So you count to the excess depreciation there. Excess depreciation there. This will be done at reporting. So we add a 3. We go to the assets and now add the 3. You see, someone can also do this like this. Someone can decide not to subtract the 18 from the assets. But the person will say that, okay, the carrying value that is included in the asset is 125. Am I correct?
Yeah.
The carrying value that has been included in the asset for this year is 125. Is that correct? Because they haven't accounted for the 18. They just took the asset at 150 and depreciate it. So they just took the 25 from the cost. So the carrying value over there is 125. But what should have been the actual carrying value? What should have been the actual carrying value? Would that be 132 minus 22?
What?
Okay,
110.
110. What is the difference? The difference is 15.
15.
Isn't it? Okay.
Yes.
So what we do is that it means that we have overstated our asset by 15. Let's go there and take the 15 from the asset. And you can see that you have negative 18 plus 5. It is same as minus 15. So someone can just find a difference and take the 15 from the PPE. But since you are looking for more ticks, subtract the 18 and might add the 3. Since you are looking for more
Okay.
ticks, just subtract the 18 and add the 3. Okay. In the exam, there is no shortcut, because if you do the shortcut, it will affect you. All right, it will affect you. So let's take the other footnote. I hope we are done with that particular one. Let's take
Linus.
Linus, please, somebody is asking, where is the 25? Please, where is the 125?
Hey, is it that me? I'm not reading. Okay, why is the 125? I'm reading only the old chart. I don't have access to the new one. So okay. We know that the asset was purchased at what, 150, isn't it? Okay. So they didn't subtract the discount amount. So they didn't subtract the discount amount. Right.
My part.
All right. Yeah, Deborah, your hand is up. I wanted to explain something before your hand is up.
Senior,
Yeah.
you see with the 132, when we subtract the 115 minus 180, you will get the value of as 132. How will you treat the 132 as the actual value of the asset?
The 132 supposed to be the actual value of the asset. Then you depreciate it for 6 years. Okay. So this will be the value of the asset that will be added to the PPE. But this value will be what? Will be used for 6 years. So you depreciate it. That will be 132 divided by 6. So we are having 22. Okay. That should have
So
been
meaning the 150 was added. So the 150 has already been added, but we are supposed to subtract the
18 from
the
it.
18 from it to reduce it to the 132.
Yes. And that is how we have
Okay.
subtracted the 18 from the tangible asset.
Okay.
All right. Okay, so let me take the person asking by the 125. Okay, what the entity has done is that they took the asset at 150 and depreciate it for a year. And a year depreciation is 25. So if you want to find the carrying value is the cost minus the accumulated depreciation. So 150 minus 25 is the 125. If they should do the right thing, the net value of the asset will be 132, which will be depreciated for 6 years. So every year depreciation is 22. So how do you find the carrying value at the reporting date? It is the 132 minus the portion that you have used, and that will be 110. So you just find the difference. I hope I've answered the 125. Okay.
Not really, because not really. You said every year is every year depreciation is 25.
Yes, please. And it's 6
Is that
years.
what I heard?
It's
Is
6
it
years.
constant?
Yeah, they are using
6
straight line method.
period.
They are using straight line method.
Okay. Fine.
Are we okay now? All right. Let's take the E. The E is also another important area. That is why I want to solve this question. Okay. Please, whatever be the case, you have to be on top of your standards because they are now changing the way of setting the exams. Consolidation, most of the footnotes will be having standards. So you have to be on top of the standards. You can see that for D, we have dealt with what? PPE. For the C, we have dealt with what? Intangibles, 38. And the E over here, we are still coming to deal with what? PPE and also change in accounting policy, which is the IAS 8. So you have to be on top of your standards. It's very important. Let's take the E.
It is well. The policy of the group is now to state property, plant, and equipment at depreciated historical cost. The group changed from revaluation model to cost model under IAS 16 property, plant, and equipment at the current year start and restated all of its property, plant, and equipment to historical cost in the year, except for the property, plant, and equipment of Tesano. The directors of Tesano had revalued these on the first day of the current year. The values were incorporated in the financial records, creating a revaluation reserve of 210 million Ghana cedis. The property, plant, and equipment of Tesano were originally purchased 2 years before the start of the current year at a cost of 900 million Ghana cedis. The historical cost of the asset was being depreciated over 6 years on a straight line basis before the revaluation. The group does not make an annual transfer from revaluation reserves to the retained earnings in respect of excess depreciation charged on revalued property, plant, and equipment of Tesano.
Okay. What are they talking about over here? This is a change in accounting policy, isn't it? There is not a change in an estimate. This is a change in accounting policy. A change in a revaluation or a change in the what? In the model for accounting for properties, a change in accounting policy. You are changing from revaluation model to cost model. It's a change in what? Accounting policy. We are not estimating or we are not changing the method of depreciation. We are saying that every asset that we are going to be buying will be accounted for using cost model. That is our policy. Now we want to change to revaluation model, or we are changing from revaluation model to what? Cost model. This particular change should be what? Apply retrospectively because it's a change in accounting policy. It's not a change in an estimate. So what we have to do is that we have to start doing everything from the time that the asset was purchased. So the policy is now to state what? Property, plant, and equipment at depreciated historical what? Cost. This technically means that they are changing from revaluation model to cost model. The group changed from revaluation model to cost model under IAS 16 property, plant, and equipment at the current year starts. It's just the beginning of this year. Why are they giving beginning of this year? Because they don't want you to what? They don't want you to stress yourself. Because the adjustment is going to be plenty. So we are giving you only 1 year. Okay. And restate all of its property, plant, and equipment to historical cost in the year except for the property, plant, and equipment of Tesano. The directors of Tesano had revalued this on the first day of the current year. These values were incorporated in the financial records, creating a revaluation reserve of 210. Okay. So that is the other component of equity, isn't it?
Yes.
Okay. So that is the other component of equity. Okay. That is nice. Okay. The property, plant, and equipment of Tesano were originally purchased 2 years before the start of the current year at a cost of what? 900. The historical cost of the asset was depreciated over 6 years on straight line basis before the revaluation. The group does not make annual transfer from revaluation reserve to retained earnings in respect of excess depreciation charged on revalued property, plant, and equipment of Tesano. So if they are making a transfer from retain earnings or revaluation reserve to retain earnings, they will not be having the 210 as the property there. So what do we have to do? What is the first thing that we have to do? What do we have to do? Okay, first of all, it means that we are going to be reversing what? The revaluation surplus. Are we
Yeah.
okay? Okay.
Okay.
Yes.
The 210 must be reversed because since we are using cost model, right,
Cost.
means that the asset has been depreciated or the asset has been accounted for using cost model from the date that it has been purchased. It is going to be having a retrospective effect. Okay. So what we do is that we first of all reverse what? The revaluation surplus. Who is having a revaluation surplus?
First annual.
Oh, it is what? If you
My
are there,
brother, that's all. You don't waste your time.
okay. So we first of all reverse the what? The this one over here. So the reversal can also be, so the other component of equity, someone can decide to put, so you can just do the reversal, the revaluation reserve. Maybe you just reverse it, revaluation reserve. So that should be here. Then we subtract the 210. Then we go to the statement of financial position. Okay, the other component of equity, we are not bringing it. So it means that we are not going to have any other component of equity at all. Okay, so we have to ask ourselves now, okay, the revaluation surplus of 210, is it added to the asset? It will be added to the asset, isn't it?
Yes, it was
Yes.
added.
So it means that the 210 is part of the TP, isn't it?
Yes.
Yes.
Because it will be 900 plus what 210. Okay, so the carrying value was 900 at the beginning of the year. We have revalued and the revaluation surplus is 210. It means that the revalued amount will be 110. And this is now the value of the asset that will be adding there. So go and subtract your 210 over here. You also have another way of doing this one, but let's subtract the 210. Okay. We ask ourselves, if the revaluation was not done, what should have been the depreciation every year? If we are using cost model, what should have been the depreciation every year?
150.
Okay, that would be, they have given you the cost, isn't it?
Yes, 900
900 over 6. That is a full year.
over 6.
Okay. So if the asset is not revalued, it should have been 900 over 6. That would be 150, isn't it? Okay.
Yes.
But what was the depreciation charge for this year? It is 1110 divided by 6 because the revaluation was done at the beginning of the year. The revaluation was done.
No, is it not divided by 4?
No, I'm coming. The
Okay.
property, plants, and equipment were originally purchased 2 years before. Okay, sorry. So the property, plants, and equipment of Tesla were originally purchased 2 years before the start of the current year at cost of what? 900. So
900.
it has been purchased 2 years ago at 900. But at the date of the revaluation, the asset is now having a remaining useful life of 4 years. Okay, so the depreciation will be, the revalued amount will be spread over 4 years. I was thinking it was purchased at the beginning of the year. Okay, so that will be 4 years. What are we having?
But Linus, even with that, I have reservations with the 110. Because if this is the beginning of the third year,
It should be.
then why
Okay,
are we still recording 900?
sorry.
Because we might have charged depreciation for 2 years,
Okay,
which will
It
bring
should
it
be
to 600.
810.
okay.
Yes,
Mhm.
600 plus
It should be
210.
810. 600
Yes.
plus 210.
Okay,
Yes.
okay. So the
Yes.
depreciation for 2 years. Okay, all right. So I was thinking is still, we are doing all of these things at the beginning of the year. So we have done 2 years already.
Yes.
So that will be 300 against the 900. So we have the cost minus what? Accumulated depreciation. Then now plus the revaluation surplus, isn't it?
Yes.
By 4. Okay. What are we having?
202.5.
Okay, 202.5. So the depreciation charge for the year is what? 202.5. But the actual depreciation should have been what?
150.
150.
So what is the excess depreciation?
It's 52.5.
Okay. The excess depreciation is 202.5 minus 150. And that will be 52.5. How would this be treated?
To be added back to the assets.
Okay, it will be added back to the asset and also what?
And also
The retained earnings.
Okay.
Tesanos net asset.
Tesanos net asset.
So excess depreciation. So we have 52.5. Okay.
Hmm.
We go here. You can see the question is not that plain.
It's really tough.
Yeah.
This is a full standard question. Oh, that was brought as a footnote.
So okay, let's now come here. If the asset was not revalued, what should have been the carrying value at this current year? At this current year end, would that be 450? If the asset is not revalued at this
Yes,
current year
600
end,
minus 150. Yes.
okay, it will be 450, or it will be 3 years. It will be remaining 3 years. So
Yes.
900 is 6 years, so that will be 450. But what is the carrying value reported for this year based on a revaluation? That will be
810.
That will be 810 minus the depreciation charge for the year.
Okay.
So that will be 810 minus 20.5. So what will be the carrying value?
07.5.
07.
607.
Okay.
6.
607.5. What is the difference?
Between that and the 450.
Yes.
157.5.
157 point what?
5.
So someone can also say that the asset for this year has been increased by 157.5. So the person can go and subtract the 157.5 from this particular one. Just put these two together. Negative 210 plus 52 point. That particular one, you'll be having the same answer.
Yeah, 157.
Okay.
Okay.
So instead of you subtracting 210 and be adding the 52, you just ask yourself, if the revaluation was not done, what should have been the carrying value of the asset? And what is the carrying value included in the PPE for this year? So you just find the difference and going to adjust it. That is all. All right.
Wow.
Okay. So, but we are looking for more ticks. So we do it the ticks way. Okay. That is for that particular issue there. It is the group policy to measure non-controlling interest at fair value. We have done all of those ones already. Let's take the last one.
The goodwill resulting from the acquisition of Mamobi was tested for impairment at the first and second year after acquisition, and at the current year end. The first and second impairment reviews revealed no impairment loss. However, the current review identified a recoverable amount of 2,427 million Ghana cedi for Mamobi. There has been no impairment in Tesanos goodwill since acquisition.
Okay. So we are doing the impairment for only what?
Mamobi.
Mamobi. Okay. So what we do now is that we have to look.
So we are done with the footnote, the E.
Yeah, we are done with the E.
Oh, okay.
You can see that it's very simple, but just that is plenty. Okay. So that one is just a change in accounting policy. So you apply, the new policy will be applied from the date of what? The date of the transaction, the original transaction. So it means that you'll be applying the cost model from the time that the asset was purchased up to today. No revaluation model. So you just ask yourself if the company should be using the cost model up to date. What should have been the issues, and what are the things that have been done under the revaluation model? So you go and reverse all those things under the revaluation model. That is all. All right.
Okay. Thank you.
Okay, let's now look at, we are doing the what? The impairment for what? Mamobi, isn't it? Okay, so what we do? When are we doing the impairment?
At reporting.
At reporting. So we look at the net asset, the total net asset of what? Of Mamobi at reporting. So let's go and look for that particular asset of Mamobi. So we can find the net asset over here. I hope we can find it over here, isn't it? So let's put the net asset of Mamobi together. The reporting one.
I'm getting 2325.
Someone should confirm.
2.25.
Confirmed.
Okay. Okay. So this one, what you do is, this is how you calculate it. Another way of calculating the net asset is, you can also confirm it like this. You look at this one. Take the net asset from this figure. What is the net asset for them over here? Mamobi, what is their net asset? So you just do your total asset minus your total liabilities. You can take it from the book value. Okay. The total liabilities will be, so the net asset is 2,400. Are we okay? From the
No.
statement of financial position is 2,400. This is their net asset, Mamobi, which is this plus this. These figures are at reporting, isn't it?
Yes.
Okay. But these figures, what you do is that you have to come and adjust them, because the retained earnings over here, there are certain things that happen during the year which has not been taken into consideration. So how do you adjust those ones? You come to the reporting, the post-reporting items over here. So you can take the 2,400, then you now subtract the 60, 80, and add a 3. That's all. So the 2,400, then you subtract 60, you subtract 18, then you add 3 to it. 2325. Am I correct?
Yeah,
Yeah,
2.25.
Okay. It's the same as you using the reporting figures. It's the same thing. Because this plus this is 2,400, and you are subtracting these figures from it. That's all.
Okay.
So you can just take from the net,
I
from
was
the
confused.
from the book value there, then you just adjust it with the post-acquisition items. Okay. That is the net asset without what? Goodwill, isn't it? Net asset without what? Goodwill. So we do the total net asset, the total carrying value of their net assets. So at reporting will be the two. Okay, let's look at the asset itself. So net asset excluding goodwill be 2325. Then you add goodwill. This is just like impairment of a subsidiary. You put the total net asset of the subsidiary together. So you look at the physical assets. Okay, the goodwill that we have, we have two goodwills. One is what? One is 252, isn't it?
Okay.
This particular goodwill is relating to what? Mamobi. The parent is having this goodwill because of the acquisition of Mamobi, isn't it? All right. So the goodwill is attributed to what? Mamobi, not the parent. So if you want to know the total net asset of the what? Of the subsidiary, you add the physical asset, which is the one given to you by the net asset at reporting. Then there is intangible asset that we are not seeing. So you add a 252 to it. Okay.
Okay.
All right.
Thank you.
So that will be 252. What is the supposed value of the net assets?
2577.
Okay, 2577. What is the recoverable amount given to us?
2427.
The recoverable amount is 2427.
27.
What is the difference?
150.
150. So this 150 is relating to what?
Impairment.
That's the impairment.
So that is the goodwill. This is relating to goodwill. The impairments, maybe we can have an impairment of 300, which is higher than the goodwill. So goodwill will take 252. Then the remaining one will go to what? Maybe the other asset. The question will tell you how you to share it among the other assets. Okay.
Okay.
So this 150, since the goodwill is 262, the 150 will be taken by the goodwill. So we come to this particular place. Then we have goodwill, the impairment of goodwill over here. Okay, so we have the impairment of the goodwill. Impairment is 150. So what will be the goodwill now? What will be the
102.
102? So can we find the total goodwill and put it there? Total goodwill will be 267 plus 102. So let's go and send the goodwill figure there. So we can say workings 5 or something. That will be 102 plus the 267. I'm sure it's 267. Okay. 102 plus 267. So 369. 369. But what will happen to the goodwill impairment? It will be shared among the NCI and then the what? So share of impairments. The NCF for Mamobi is 20%. Am I correct? Am I correct?
Yes.
Okay.
Yes.
So what will be their? I'm having 30.
Confirmed.
Okay. So we can now go and put our group return earnings here. So let's go and put that. I should have brought the group return earnings long time. So the group return earnings, we can now bring it over here. So that will be for the parent. What is the parent return earnings?
1875.
1875. So what do we bring? We bring the share of the impairment over here because they are using full goodwill method. Okay, so that will be 0.8 times 150. What are we having?
120.
Okay, so that will be a reduction. So we now look at share of our post-acquisition profits. Share of post-acquisition profits. Let's now determine our post-acquisition profit for each of these people. So the net asset at acquisition over here is 900. What will be the for the reporting? I'm having a difference of 82.5.
Confirmed.
Okay, this is for Tesano, isn't it?
Yeah.
And this particular amount will be shared as 60-40. Are we okay? Okay. So the share of profits in Tesano will be 0.4 times 82.5. Okay. And the share of this one, Tesano will be 0.6 times 82.5. What are we having for the two? I'm having 49.5 for this one. And 33. Okay. Let's go to our net assets for them. What is the net asset over here? We have 2130. And this was 2325. I'm sure I'm correct. Is that correct? Please, can we confirm that? All right. So 2325. What is the difference?
195.
Okay. Okay, so that'll be 195. Okay. Do you know you can also determine the 195 like this without putting your net asset at reporting? Serious. Do you know you can determine the 195 over here without drawing your net asset at reporting?
No.
No, please teach us.
Okay. What are we looking for? The 195, what are we looking for? It's no profit.
Post-acquisition profits, yes.
Okay. Look at the retained earnings given to us. What is the post-acquisition profit in the retained earnings?
It's a difference of 300.
Okay. So this 300 is the post-acquisition profit. But this profit was determined without taking into consideration certain items. So we have to adjust this particular profit with the post-acquisition items now. So you take your 300, you can see that development inventory has been what? Has been capitalized instead of expensing. So this has not been subtracted from what? Our profits. So we have to come and take the 60 from it. Okay. Instead of us subtracting this from our assets, it has been treated as income, which is included in the 300 within the year. We have to come and what? Take it. So since we didn't subtract this from the asset, we have charged the depreciation over by what? 3 million. It means that we have reduced our profit by 3 million. We have to go and increase it. So you now add your 3 over here. Subtract and see whether you get a 195. Okay, the inventory that was sold during the year, sorry. The inventory that was sold during the year, it was sold, but no cost has been recognized for it. Okay. The inventory value has increased by 30 during the year. That is the cost, but it has been sold, but that particular cost has not been taken into consideration. So you recognize
Yes.
inventory as cost. Okay. So
Yes, you get 195.
okay. Okay. So is this particular thing is what we are doing under the net assets. But if this should be profit or loss, you see that we'll be adding this 60 to maybe administrative expenses, this 18 to what? Maybe administrative expenses. Then we'll be subtracting this from cost of sales. We'll be adding this one also to cost of sales. It's just the post acquisition items that we are adjusting against our profit. And we will, at the end of the day, get a 195. So mostly me, I get my post-acquisition profit without preparing the net asset. I only do the net asset at acquisition for goodwill. That's all. I don't have time to come and be doing all these things. So let's put them together and then move on. So our NCA, the total will be what? Okay. So let's share the profit for them. So there will be a share of profit, which is 195, share of profits. This particular one, NCA will be having 20%, 195, and the parent will be having share of post-acquisition profits. That will be Mamobi, that will be 0.8 times 195. Let's
So
get it.
at which point do we separate the
NCI
okay. There was no other comprehensive
income. There was no other comprehensive income. Okay.
Yeah.
So the
Okay.
movement is typically
It's just the retained earnings.
yes, please.
Thank
Okay.
you.
So you can put them together, then you do your issues. But let's start with certain standards now. Let's start with certain standards now. Okay. So let's see whether we can do with some standards before. Okay. So someone should put this thing together so that I can share the solution. I'll put yesterday own and also today's own together. Hey, does it mean that I don't have? The law says that when a non-resident trust Okay. So let's now start with certain standards now. Okay, so okay. The break, let's take, it's 8:11. Let's come back 8:30. Okay. That is okay. So let's see whether we can take two questions each on the standards at least. If we can do maybe 4 of the standards today, maybe tomorrow we'll continue with the rest. So let's start with the IAS 36, impairment of assets. So we try to solve the first question and at least the last question, which is but I will explain the question 2, but we also try the last question, which is question 4. The question 4 is about impairment of subsidiary, which is an important area also for corporate reporting. Okay. But the question 1 is impairment of corporate assets. What do we call a corporate asset? We will look at that particular issue. So for the standards, you have to be, you see, those borrowing costs and those ones are not areas that will be coming for corporate reporting. So the standards, you have to be very focused on the major ones, which is the 36. You have to be very focused on the 36. The 36, what are the things that you should be looking out for? What are the things that you should be looking out for? You should be looking at complex issues. You should be looking at complex issues, maybe impairment of a subsidiary, or impairment of what we call a corporate asset. Impairment of a corporate asset. Okay, I'll check. Okay, Sines, I hope you can hear me.
Yes, we can hear you, Sine.
So you focus on impairment of corporate assets, which is now like a new area that most of us, we are now having access to that particular information, but because those days they don't really talk about these issues. So you also talk about the reversal of impairment. The reversal of an impairment. So reversal of impairment, the impairment of a subsidiary will always be seen as what? A cash generating unit. So even the impairment of the cash generating unit is still under the impairment of the subsidiary, because the subsidiary will be treated as if it's a cash generating unit. So these are the major issues that you should be looking at if you come to the impairment of assets, which is the 36. You should be looking for complex issues, not issues like maybe simple issues like impairment of a single asset, where you'll be having, maybe they will give you the cash flows and then also the net realizable value. That some simple ones, those are for financial reporting. Corporate reporting, you should be looking at complex issues. Even if it is an impairment of a single asset, you are going to be having a complex issues. You should also be looking at the impairment of corporate assets. What do we call as a corporate asset? A corporate asset is an asset that is being used by maybe all the branches of the company. So you have about 5 companies, 5 different branches. They all use a research and development center. The research and development center cannot be attributable to only one entity. So it is therefore called a corporate asset. If you have a lab, the company has a lab, and the company has a group of 3. We have 3 different subsidiaries under the parents, and all these subsidiaries together with the parent, they use the lab. The lab cannot be attributable to the parent itself, cannot be attributable to the subsidiary. It's just an asset that is for the company as a whole. So that particular lab that is being accessible by, or that is being accessed by all the companies under the group, is called a corporate asset. How do we carry out impairment tests on it? Because they are not attributable to a particular cash generating unit or a particular company. How do we go with that particular issue? Reversal of impairment. There was an impairment test before. Now, the condition that is bringing the impairments loss, or that triggered the impairment loss, is no longer there. Maybe we purchase an asset. Government has now passed a legislation that is going to be restricting the asset on how we are going to be using it. We budgeted that we are going to be producing 20,000 units every year with the assets. Government has now passed what legislation that is restricting the asset usage. So we have now saying that what the asset is what will be producing only 15,000. Okay. You see, we are saying that the asset has a value of 20,000 based on the benefits. So if the asset is producing 20,000, it means that the value will be what? 20,000 Ghana cedis. Now, the asset is going to be producing the 15,000. The question is, the asset value cannot be what? 20,000 and still be giving you a benefit of 15,000. The estimate is that if the value is 20,000, the benefit should be what? 20,000 units. Now, if it is 15,000, it means that the value of the asset will no longer be what? Be 20,000, because the benefit that will be given to will be less. So what should have been the value of the asset that will give us a benefit of the 15,000? That is the impairment that we are talking about. We are saying that if the value is 20,000, the asset will be producing 20,000 units every year. Now, government has now passed a legislation that is going to be restricting the production to 15,000. The assumption is that the value of the asset can no longer be 20,000, because the 20,000 will be giving us 20,000 units. Now, what will be the value that will be giving us the 15,000 units? And that's what we call the recoverable amount. So we just try to what? Find the value of the assets equivalent to its benefit that will be given to us. So the benefit that you'll be getting will be what? Lower than the what? The actual cost. So we find the actual value that will be giving us that particular benefit. That particular actual value that we want to find is what we call the recoverable amount. So you carry out an impairment test on the asset first, and the legislation which has been passed by the government is no longer there. It means that the asset will now be utilized up to 20,000 units. It means that there should not be any impairment in the first place. You have to revalue, or you have to carry the impairment test on the asset again and see whether impairment has actually taken place or not. When do we say there is an impairment loss? We say there is an impairment loss when the carrying value is greater than the recoverable amount. What do we call the recoverable amount? Is the amount that the asset the company is going to what? Get from the asset, either through sale or continual use. Recoverable amount is the value or the benefit that the company is going to be getting from the asset, either through continual use or through a sale. But the recoverable amount will always be the higher of the value in use or the net realizable value. So first of all, you have to know that you can only say an asset has impaired when the value that you have in the books is higher than the value that you are going to recover from it, either through sale or continual use. All right. That is basically about the impairments. I don't want to talk about plenty issues again. And if you pick a question, we'll be able to talk about those issues. So you have to focus on the impairment, which is 36. It's a major standard. Okay. The next one is you also have to focus on which one we call the IFRS 5, which is non-current asset held for sale and discontinued operation. It's just like the impairment test. It's just like a brother to the impairment test. That is it works like the impairment of asset, but just that this one, the recoverable amount under the IFRS 5, which is the non-current asset held for sale, the recoverable amount is restricted to the net realizable value, because we only classify an asset as held for sale when the purpose is to recover the carrying value through a sale. So an asset will be classified as held for sale if only the entity is going to recover the carrying value through a sale. It's not going to be through continual use. So that is the only difference. The recoverable amount under the IFRS 5 is restricted to what? To the net realizable value. Yeah, wait. All right, awesome. Okay, it's restricted to this particular one. When do we say that the asset is held for sale? The company has an asset, Assets can be purchased for so many reasons. It can be for resale, it can be for administrative purposes, it can be for renters. So the company has now seen that, okay, this particular asset, we don't need it again. So we want to sell it. If they want to sell it, it means that this particular asset will now be what? Will not be used or will not be used for anything, but it will now be classified as what? For sale. Like the way people have been selling the people have been writing the for sale on the car. So they have to put the asset up for sale. That is the head for sale that we are talking about, making a decision not to use the asset for its purpose, but now to dispose it of before because you don't need it again. But you can't say you are going to sell an asset when the asset is with what? Is with a mechanic or with your mechanic, or the asset is at a mechanic shop. No. It means that you are not ready to sell. If you want to sell the asset should be in a present condition that will be available for immediate sale. The asset should be in a condition for sale, immediate condition for sale, or it should be in a condition for immediate sale. You can't say you are going to sell an asset, the asset is at a mechanic shop, which they are going to be taking 2 years to do the work. My brother, you are not willing to sell. Whenever you are going to sell, the management must be committed to the plan to sell. We want to sell the assets. If you want to sell the asset, you want to sell a typewriter and you are making 20 million for typewriter, who is going to buy? It means that you don't want to sell. You don't want to sell. Even if you want to sell within 6 months, you are not able to sell, you are still determined to sell. So management must be committed to the plan to sell. The sale must be what? Probable. It must be within 12 months. Plans must be taken into consideration to get what? A buyer for the asset. These are the conditions. These are the things that you can see to determine whether the asset should be classified as held for sale or not. If all these conditions are being met, how do we classify the assets? It's just like the impairments. The asset should be classified lower of the cost or its net realizable value. Why are we saying that? Because the asset is carried under cost model. So at the time that you want to classify the asset, find the carrying value of the asset. Find the recoverable amount of the asset. What are you doing? You are just carrying out impairment tests on the asset. So at this date, you just ask yourself, has the asset impaired or not? That is it. And this is always under the cost model. What if the asset is carried under the revaluation model? What do we do? The revaluation model, you first have to revalue the asset before you classify it. So the asset will always be classified at the net realizable value. The asset will always be classified at the net realizable value because we first revalue the asset before we classify. So the classification will always be done at the net realizable value. This particular one, the issue with lower of cost and those one does not specifically apply to this one. The asset will always be classified at what? The net realizable value. Okay. This is relating to a single asset. If the company wants to sell a single asset, like you just want to say, you just want to sell our plants. What if you want to sell a provision shop? What if you want to sell a provision shop? You see that a provision shop, you'll be selling everything. You'll be selling the container, you'll be selling the tables, everything inside. So you are selling a lot of things within a single transaction. Just a single transaction, you are selling the tables in the provision store, you are selling the bulbs, you are selling the container itself. In that particular case, that provision shop will be seen as disposable group. Okay, the disposable group is just the opposite of the cash generating unit. If you are making a decision to sell a cash generating unit, it is called a disposable group. What do we call a disposable group? It's a group of assets that will be sold in a single transaction. Just a single transaction, a lot of those assets will be sold. So we look at the disposable group. When do we classify, or when the decision is being made to sell a disposable group, what do? We use or we measure the asset at the date of the decision using their specific standards. Those assets that are carried under revaluation model must first be revalued before you classify. Those assets that are carried under cost model, you must first depreciate them before you classify. Inventories, receivables, all those assets must be measured using their applicable standards before you classify as held for sale. So that all the assets must be remeasured at the date of the decision before we classify as held for sale. If there is any impairment loss after the classification, the impairment loss will be shared among the assets under the
disposable goods.
Yeah, under the allocation specified under IAS 36, where we share the impairment loss to assets. Goodwill will take it first, or physically damaged asset will take it first. Goodwill will take it. Then the other non-current assets that are likely to be impaired will now take it on their pro rata basis or on their carrying value at the date of the impairment. That is about the IFRS 5. You have to be looking at, you don't have to look at classification of a single asset. You have to be looking at what? Classification of a disposable group. How do you account for it? That is a complex issue there. You can also have to look at whenever there is what? A change of plan. We want to sell the assets. We want to sell the assets. Now we don't want to sell again. What do? We account for the asset as if there is no what? Plan to sell. So if there was no plan to sell, how should have been the asset accounted for? So we account for the asset as if there is no plan to sell. So we look at the carrying value. So if the asset was not classified as held for sale, or no decision was made to classify the asset as held for sale, what do we have? So we calculate the carrying value out to the date of the change. Then we look at the recoverable amounts. We just want to know whether the asset has been impaired or not. So you compare the carrying value to the recoverable amount and see whether the asset has impaired or not. If the asset has not impaired, you pick the carrying value. So if there is a change of plan, the first thing is that you have to ask yourself, what is causing the change? There are certain things that will be bringing the asset not to be sold at that particular time. The standard says that the sale should be within a year, 12 months. So after 12 months, the asset has not been sold. The asset should be reclassified immediately. But there are certain things that will cause a delay. The first one is there is a situation that is beyond the control of the country. Government has passed a legislation that assets of this type should not be sold during this particular period. The company does not have control over that particular legislation. So the delay is not caused by them. So the asset can still be classified as held for sale because the delay is something beyond the control of the company. If the delay is not is not beyond the control of the company, is management still committed to the plan to sell? If there is that kind of willingness to sell the asset, they are still committed to sell the asset, then we can still classify the asset. But if these two conditions are not there, after 12 months, the asset should be reclassified immediately. How do you do the reclassification? You account for the asset as if there is no plan to sell at the date of the change. Then you compare with the recoverable amount to see if there's any goodwill at the date of the change or something like that. Okay, let's also come to the next issue that you should be looking at is financial instruments, IFRS 9. Yes, whether you like it or not, this sitting financial instrument will come. Okay, so you have to prepare for it. What are the things that you have to prepare for? First of all, you have to know the classification of the financial instruments. They can be classified as financial assets or financial liabilities. Financial liabilities, how do we account for them? The classification under the financial liabilities are only two: held through profit or loss or not through profit or loss. Those through profit or loss, how do we account for them? True profit or loss means that the asset is being held for trading purposes. Trading purposes means that it can be sold within a year.
I can slow a bit.
Please, what are you saying?
Yeah, please, you are moving fast.
Okay, don't worry. My speed is automatic, so I'll slow it down. Okay. All right. So the the financial liability, under the financial liability, we have two main classifications. It can be true profit or loss, or not true what? Profit or loss. If the classification is done through profit or loss, means that this particular instrument is held for trading purposes. Trading purpose means that it can be sold at any time, or we assume that it will be sold within a year. Therefore, any cost that is incurred on this particular asset, maybe you acquire the asset at 200 million, but before you acquire this one, you have incurred a cost, a transaction cost, or maybe you have paid to an agent that got the buyer for you, and you have incurred a cost of 5 million. Okay, this particular cost of 5 million, since the asset will be sold within a year, it means that this particular cost also will be consumed within a year. Therefore, you expense the transaction cost, because the transaction cost must be what? Consumed over the what? Over the useful life of the instrument. Since the instrument will last for only 1 year, it means that the cost must also be consumed within a year. Therefore, you expense the what? The transaction cost. Any discount allowed will also be what? Expense, because the discount allowed will also be consumed within a year. Okay. If it is not true profit or loss, it means that this particular asset is seen as a non-current what? Liability. This particular instrument is seen as a non-current liability. Therefore, it is going to be there for some number of years. What happened? If you incur transaction costs, the transaction costs have to be consumed over the useful life of the instrument. Therefore, we capitalize the transaction cost. We also capitalize the what? The discounts. So if the asset is having 3 years, you have to what? Amortize the transaction cost over 3 years. The discount must also be enjoyed over 3 years. So you capitalize the transaction cost and also the discount. Capitalizing means that you subtract it from the liabilities. Then you now use the effective interest for your calculation. That is also very important. Let's come to financial assets. Under the financial assets, okay, so this is how do we account for this one? The initial recognition is fair value. Okay, fair value, any transaction cost expense, any discount allowed expense. But if it is not through profit or loss, it is also initially recognized as what? Fair value, while the transaction cost will be capitalized, discount will be capitalized. What happened? Subsequent measurement, we have the amortized cost. We all know how we go about the amortized cost. But for the profit or loss, what we do is that at the end of every year, we look for the fair value of the asset and see whether there is an increase or a decrease. Any increase or decrease in movement of the fair value should be recognized to profit or loss. Okay, let's come to financial assets. Financial assets can be gotten through equity instruments, where the company will be investing in the shares of another company, or can also be through debt instruments. Okay, where the company will be investing in the what? Or be purchasing a debt instrument of another company. If it is through equity instruments, the classification is only two: through profit or loss, or through other comprehensive income. Okay, if it is through profit or loss, the initial recognition is the same as what? For financial liability. Transaction cost will be expense, discount received will be also be what? Will be expense. So all of them will be taken to profit or loss. But if it is through other comprehensive income, means that the asset cannot be sold within the year. Okay, it will not be held up to maturity. If it is 2 years or 4 years, okay, this particular 4 years, we can decide to sell maybe before the 4 years, maybe at the end of the 3rd year, but we cannot keep it up to the 4th year. But it will not be what? Sold within a year. But it also not be what? Kept at the end of what? The maturity period. So what we do is that we capitalize the transaction cost, the discount received, all of them will be what? will be capitalized. Capitalizing means that we either add or subtract from the financial assets. Whatever happens is that at the end of every year, we fair value the two of them. We fair value the two of them. We fair value the two of them. If it is true that debt instruments, how do we also classify? The classification is the same as these two, but we add another one, which is the amortized cost. Okay, the amortized cost, the instrument that will be carried to the amortized cost is the instrument that the company is willing to hold it up to maturity. So the question will tell you that the company is willing to what? To hold this particular instrument up to maturity, and they will collect the cash flows up to that particular period. That will be under the amortized cost. The entity is willing to keep the instruments up to maturity. They will not sell it within any period. That is the amortized cost. But if you come to the other comprehensive income, the question will tell you that the entity is willing to keep the instrument up to maturity, but they are also waiting for what? Any opportunity or any better opportunity that will come out and they will sell it. So they are indifferent whether to sell it or to hold it up to maturity. So the question will tell you that is the business model for the company. The company is indifferent as to what? Either sell it or keep it. So they will be holding it up to maturity and also looking for better opportunity to sell it before that time. In that case, you use the classification as other comprehensive income. But for profit or loss, they will say it is being for speculative purposes or trading purposes. It is being bought purposely for what? Business. Sell it and get a capital gain. That is all. That will be true profit or loss. But these are not issues that can be examined at the corporate reporting level, although they can do it, but it's no issue that will be in the corporate reporting level. The main issue that you should be looking at is what we call the hybrid instruments. Okay. The hybrid instruments. What do we call a hybrid instrument? An instrument that is having a component of debt and also a component of equity. Always the question will say that it's a convertible instrument. An instrument that the holders will be given the right to convert it into equity shares at the end of maturity period, or they should convert it at par value. They should either receive cash or receive shares at the end of the maturity date. That is will be the convertible instrument. So any instrument that the question is saying that the holders have the right to convert it to equity shares or receive cash at this date, that's the convertible instrument. You have to determine your debt component and also the equity component, which is always the options to convert. How do you determine the debt component? The debt component is just the present value of all the cash flows. All the cash flows over here is the interest, the coupon that you'll be receiving, and also the par value that or the redemption value that you'll be receiving at the end of the maturity period. You present value this using the interest rate of a similar instrument without conversion. Then subsequent measurement, the debt will be accounted for using amortized cost, but the equity will not be remeasured. Equity will not be remeasured. Sometimes the question can tell you that the option has been exercised. That will either result in a discount issue or a premium issue. I don't want to go there. So after the hybrid instrument, we can also look at what we call factoring. Okay, factoring of receivables. The company will be selling their receivables to a FATA, a debt collection company, or they will be contracting a debt collection company to collect the receivables on their behalf. You have to be very careful with this one. One of them, we have what we call factoring with a recourse and factoring without a recourse. So if it is without a recourse, that's what is the meaning? Factoring without a recourse. The factoring without a recourse means that the company is going to sell the receivables to the factory company, and that is final. Whether the factory company is able to receive the money from the people, that is none of their business. So the company can have a receivables of 20 million, and they will sell it to the factory company at 16 million. Okay, and this is the amount that they are going to receive. This is the final amount that they are going to receive. They will not receive any reimbursement, even if the factoring company is able to receive the remaining 4 million. This is the final amount. For this particular one, if the question says that this is the final amount, this is the first and the final amount that the company is going to be receiving, then it is factoring without a recourse. What will happen? It means that the company is receiving only 16 million out of the what? The 20 million. So the company will de-recognize the receivables because they have received only 16 million in respect of that. And they will recognize the cash, and they will now bring a bad debt of what? Of 4 million. So you have to ask yourself, is the factory without a recourse or with a recourse? How do you know? The question will tell you that the amount that the company is receiving is the first and the final amount. No reimbursement will be made to the company again. If the people are willing to collect, if the people are able to collect the money or not, the company will not receive any money from them again. That is factoring without a recourse. But if the 16 million is given to the company, and they are now giving them time that if they are not able to collect the amount within 6 months, they will pay the advance amount to them together with interest. It means that the company is just contracting the factory company to receive the money on their behalf. In that case, the upfront payment will be treated as a loan, because if the people are not willing to collect the money will be brought back to the company. So the company is just using the receivables as a collateral security to take loan. So in this case, the company will treat the upfront payment of 16 million as a loan and still keep what? The receivables. They are using the receivables to take the loan. So they will treat the 16 as a loan, and they will be charging interest on it, if any. That is not the issue. The issue that we want to look at is the major issue for corporate reporting. Okay. I'm saying that the factoring is a situation where the company will be what? Contracting a debt collection company to collect their receivables on their behalf. Or the company can sell their receivables to what? To the debt collection company for money. It's a source of finance. We don't have money, but we have a lot of receivables there. Let's go and sell part to them, or let's go for a loan and ask the people to collect the money. Okay. So a situation where we have two types of the factoring. One is without recourse, and one of them is with recourse. Okay. One of them is a situation where you need money. You have a car. You say that, okay, Charlie, I need money, but I don't have the money. So take my car. Give me the money. I won't come back for the car again. So just give me this money. You bought a car, maybe 20 billion, but you want to give it to me at 80 billion. You say that you'll never come back for the car again. You'll never come back for the car again. So in that case, I should just give you the money and take the car. You'll never come for the car again. That is the factoring without a recourse, where the factory company will give an amount to the company, and the company will not come for any reimbursement again. Whether the factory company is able to receive all the money or not is none of their business. That's what we call the factoring without a recourse. But situation where you have given the car to me that, okay, I will bring the money in 2 months' time, and I will come for the car. It's just like you are coming for an advance payment. You are taking a loan from me, and you are using the car as a collateral security. So you are going to be treating the amount given to you as a loan, because you will go back for the what? For the car. So that is the factoring with recourse. Factoring without a recourse, the receivables have to be what? Be recognized. You have to remove it because you have received money from them already. Any difference have to be treated as a bad debt. But if you come to factoring with a recourse, you are using the receivables to take loan. So the receivables will still be in the books, because if the money is not collected, they will bring the money back to you, or they will bring the debt back to you and go and come for their money. So you treat the advance payment as a loan and charge interest on it if you have the interest rate over there. Okay. The other issue is the impairment of the financial assets. Impairment of financial assets. That is the major issue that we are going to be looking at today. The financial instruments, that is the major issue that we are going to be looking at. Impairment of financial assets. We all have heard about the debt structuring, the haircut or something. Okay, you see that they are going to be restructuring. So it means that if the company is paying you interest of 6%, they will now be paying you interest of what? 5%. It means that the fair value of the asset or the interest on the investment will be reducing, or the cash flows will be reducing, and that is going to affect how you are going to manage your cash flows. So it means that the asset is going to be impairing. The fair value of the asset will no longer be as it was what? 6%. The interest was 6%. So debt restructuring is going to be making the fair value of the asset being different from what? If you present value the cash flows or the money that you'll be receiving from that particular investment. So you have to carry out an impairment test on that particular asset, which we call the financial asset. So debt restructuring is one of the factors, one of the indicators for an impairment of financial assets. The default in interest payment, default in interest payments. So maybe the entity has to pay interest for this year, but they were not able to pay. Next year too, they were not able to pay. It means that a company is in a serious cash problems. You have to carry out impairment tests on the investment that you have in that particular company. Maybe the company is facing maybe liquidity problem that they have, maybe, or the company has been granted a concession. Maybe you have granted a company a concession to now reschedule the cash payments. You can also look at the impairment of that particular asset. How do we do the impairment? The impairment, we use two issues. We use the expected time losses, expected future losses, or expected time losses, and also 12 months expected what? Losses. So we have the lifetime expected losses and also the 12-month expected losses. When do we use these of them? When do we use them? We use the lifetime expected losses when the risk of the company has increased significantly. So if the question says that the risk has been increased significantly, we use the lifetime expected losses. The lifetime expected losses is just the entire losses over the what? Over the maturity period or over the life of what? The instrument. That is the lifetime expected losses. How do you do that? You can also present value the default, or you put the defaults that will be arising from the asset in each year. You add them together to get the lifetime expected losses. The 12 months expected losses is where the risk is not significant, it's insignificant, or the risk is low. The risk level is low. We use what will be the default within the what? Within the next 12 months. So if the risk is low or the risk is at a lower level, we use the what? The 12-month expected losses. How do we calculate this? The question will give you how to calculate them. They will give you the default and then the probability. You find it and that will represent your losses. Okay, if you made a loss for the first time, that will be taken to your profit or loss as a loss, but that will be like a provision for impairments. And this will be shown as a provision in the statement of financial position as a liability. But if the asset has actually impaired, then what you do is that all the provision that you have made relating to the impairment has to be taken from the what? The carrying value of the asset. Okay, if you pick a question, you'll be able to look at that. I'm sure that I've said a lot of things about the financial assets. Another thing that you have to look at, the standard, is the IFRS 15. Revenue from contract with customers. Yeah, Augustine.
Senior.
Yeah.
Thank you. The speed is higher. I know that you have charged them, but please, I want to suggest that maybe the 3 or 4 standard that you have taken, if you can solve a question on it, then when we're meeting, then we start from the revenue from
Okay.
IFRS 15.
I don't want to talk. I don't want to go into detail again for all of them again. Let me just add additional 3 or 4 so that we just start solving questions. I'll just talk about the issues that is likely to come in the corporate reporting. Okay.
Okay, thank you.
All right, so this is revenue from contracts with customers. Okay. What is likely to appear in the corporate reporting is the recognition of the revenue. Recognition of the revenue, which will be over time or at a point in time. You have to be very careful with that. Over time means when as soon as you are done with what the work, you recognize revenue relating to the portion of the work that you have done. This always works with what? Construction what? Contracts. The revenue at a point in time is where you only recognize revenue when control, possession associated with the asset has been passed to the third party. That is at a point in time. So if the person has made any advance payments, the company has to treat the advance payment as a loan because you are here to deliver the goods to the person. Okay, but for construction contracts, the revenue is recognized at a point over time. As soon as you are done with part of the work, you measure your percentage of completion and recognize revenue relating to the portion of the work that you have done. But there's another issue. There's another issue that will deal with what we call the incremental cost. Incremental cost. The incremental cost is a situation where, or is a cost that a company has incurred as a result of what? Getting a particular contract, or a cost that has been incurred after getting a contract. It can be a commission. It can be a commission to the salespeople. So maybe you are working on a contract and the people are working on a contract. Okay. After the contract has been rewarded to the company, you have decided to pay what? Commission or bonuses to those people. These bonuses are paid after the contract has been what? Secured or awarded. But you can also incur a cost of what? Maybe traveling, transportation. You are going to prepare, you are going to present the contract to the people, so you have been traveling and those kind of things. You can see that the traveling cost, even if the contract is being awarded or the contract is being secured, you still incur the traveling cost. Okay, so all those costs that you have incurred before the contract has been awarded, it can be the proposal fee, it can be any other cost before the contract has been awarded. All those costs must be what? Expensed. All those costs must be expensed. Any cost that has been incurred, although it's relating to the contract, but it is before the contract has been awarded, it should be expensed. Example can be a legal cost. It can also be transportation. It can also be proposal, preparing, maybe printing of paper for the contract and those things. All those costs that will be incurred before must be expensed. But what will be the cost that will be incurred after the contract has been awarded, which will be commission, which will be bonus? This cost must be capitalized as a contract asset and amortized over the contract life. It will be consumed based on how the contract is being done. So if the contract will be for 3 years, this commission and bonus must be capitalized as a contract asset and which will be consumed over 3 years. If you are supplying 1,000 units and you have supplied 100 already, the contract cost must also be consumed based on what? This particular unit. So 1,000, 100 over 1,000 times the contract cost. It will be consumed based on how the contract is being delivered. If it is over years, you amortize it over years. If it is in units, you use the unit to amortize it, which will be taken to profit or loss at the end of every year. That is the main issue now under the what? The revenue from contract with customers, the incremental cost, the incremental cost. Let's look at leases. The IFRS 16. The leases over there, the one that you are going to be looking at is the sale and leaseback. Sales and leaseback. Okay, that is the corporate reporting. We can also have the lessor accounting, can also come under corporate reporting. Then we also have reassessment of lease. This is an important area, reassessment of lease. We can also have what we call foreign lease. Foreign what? Leases. Foreign leases. So foreign leases has to do with where you are going to be paying the rentals in a foreign currency. So maybe you have leased an asset from a company in Nigeria. You'll be paying the what? The rentals in what? In a foreign currency. How do you account for it? The accounting treatment is just like what? The IAS 21. The differences in foreign exchange rates. At the end of every year, you have to remeasure your liability. By the date of the transaction, you find the present value and you retranslate the present value, or you translate the present value using the spot rate at the date of the transaction. But what happens is that at the end of every year, you do your lease liability in the foreign currency and remeasure it at the reporting date. Any difference over there will be taken as what? Retranslation loss, or a loss on translation that will be taken to profit or loss. That is how we do it. So at the end of every year, you remeasure your liability. You do your liability in a foreign currency. At the end of every year, you remeasure it using the principles of IAS 21. Okay. You can also have IAS 37, which is provisions. The provision, the major issue that you have under the provision is what we call the retirement of assets, which is a change in what? In the dismantling cost. A change in dismantling cost. You might be saying that you are going to be incurring 200 million at the end of the project life, but now somewhere along the line, you have realized that no, the total provision should have been what? 300 million. How do you account for that? We will look at that particular also. Another standard is what we call the IAS 19, employees benefits. And the one that you are going to be looking at is the post-employment benefits, which will be the defined contribution scheme. Defined contribution scheme. That is what you are going to be seeing in the exam. The company will be keeping the scheme for themselves. They will be making the provision for the scheme for the employees, and the company will be managing the scheme themselves. The employment scheme, the company will be managing it themselves. So they will be creating liability because the people will still be working for them. And they will also be contributing asset towards the settlement of the liability. So that will be over there, and you have to be very careful with that one. Another one is intangibles. You can also see intangibles in the exam. And what other important standard again? 21 also can appear. Income tax can also appear, but these are the major standards that you'll be seeing in the corporate reporting. Let's take some of them before 10:30. Then tomorrow we continue. Let's take the first one, impairment of assets. Let's try and see whether we can take 2 questions from this. Okay, I've forgotten any special. Take note of that. Any special too is another issue.
Very necessary.
Yes.
Okay, question 1.
And income tax. So
Yeah, I've said the income tax.
You mentioned that's the 21, right?
It's 12. 21 is the
12.
Yeah.
21 is foreign currency.
Yes. Okay. But borrowing costs.
What's a borrowing cost?
Forget about those are financial. They can't bring a question on its own, but they can mix it with other standards, or they can easily as part of the consolidation. Okay, those minor standards, investment property, they can decide to mix them with different standards, but bringing it as a question in corporate reporting, investment property, borrowing costs, those minor ones, they are okay. Share-based payments, but I'm not seeing the share-based payment to come. Okay, I'm seeing the employees benefits, because the last time that employees benefits appeared in the exam is December 2022. So I'm seeing the employees benefit more than the share-based payment. That's why I didn't mention the share-based payment.
For me, I'm seeing the share-based payment more than the employee benefit. So there's share-based payment, and then there's reconstruction or whatever. Yeah.
Yeah. Okay. But me, I'm picking the employees benefits. So we just have to wait if we go there.
I beg.
The
We solve questions on both.
So I will solve questions on all of them. All the
Okay.
standards that we have done, at least we try to solve one question on them and use the question to explain everything. Okay. So
Okay.
let's take the first one. Senior Augustine.
Aflao, okay.
My brother, continue.
Okay. Aflao Limited produces various nutrition products through a three production facility located at Denu, VIP, and Toko. Each facility is considered as a separate cash generating unit. In May 2019, several contamination cases of AL's product were reported on social media as well as on TV channels. The adverse publicity badly affected all products, and consequently, their sales were reduced significantly. Therefore, AL conducted impairment tests of all CGUs as on 30th June 2019. Though AL does not have any intention to sell any CGU in near future.
Okay.
Following information.
Okay. You see, they are saying that AL does not have any intention to sell any CGU in the near future. What they are telling you is that the recoverable amount will be the lower of the value in use or the fair value less cost to sell. But as soon as the question says that the company has the intention to sell the assets in the near future, then your recoverable amount will be restricted to only the fair value cost to sell. It means that you are trying to classify the asset ahead for sale. So we restrict our recoverable amount to only the fair value less cost to sell. You have to be very careful with that particular one. Okay. Let's move on.
Following information was made available on 30th June 2019.
Okay.
Asset of CGUS. Deno, VP,
Okay.
and Taco.
You leave that one. Let's come to the C.
Operations are conducted from the head office. Product Development Center supports the new end VIP facility only. Required: compute carrying amount of each CGU and corporate asset after incorporating impairment losses under the following independent situations. A. Relative carrying amount of CGUs are reasonable indication of the proportion of corporate assets devoted to each CGU. And B. The carrying amounts of the corporate assets cannot be allocated on a reasonable basis to the individual CGUs.
All right, thank you. Okay, you can see that you are given a corporate asset. Okay, you can see the corporate asset over here is the head office. The head office cannot be, we can't say that the head office belongs to either the Denu, the VFR, or the Toko. Okay, it's just something that is used by the three companies. So it's an asset that is being used by the three companies, including the parent itself. So we cannot apportion that, okay, this portion of it is for these people, unless the question is saying that you should use that particular apportionment. Yes, we have shared the standard questions. That is the day 2 and day 3. Okay. Okay. So, but what are they saying? They are saying that operations are conducted from the head office. So the head office is for the three companies, but the product development center support the new and what is the facility only. So this particular, if there's any impairment on it, that particular impairment will be for the new and VFR only. Okay. Compute carry amount of each CGUs and corporate assets after incorporating impairment loss under the following independent situations. The first one, the relative carrying amount of CGUs are reasonable indication of the proportion of the corporate asset devoted to each CGUs. What they are saying is that, okay, the CGUs over here, the 84 and then the 26, we can now use the carrying value of the corporate asset over here which is 84 and 26, we can use the carrying value of each CGUs to share it to them. It can be shared to them based on their carrying value. Okay, let's look at how we normally do that. Okay, so let's take our individual CGUs. Okay, let's take our individual CGUs one by one. So for the purpose of this one, I'll be using D, V, and T. Okay, let's look at their own assets. What is the value of their own assets? We have to find the total value of them. What is the value of their own assets? The carrying value of their own assets is what?
Carrying value of the
160, 100, and 125.
Okay. So the carrying value of their own assets before that particular one is 160, 160, 160, 100.
and 125.
Okay, 100 and 125. Okay. Okay, let's take their, you see, you can use their carrying value to share. You can use their carrying value 160, 100 to share that part, to share the 84 and 26. But if you are doing that, you are being a kind of unfair to some people. Let's look at this one. The Denu is going to use the asset for how many years?
Yes.
Okay. Jeppe is going to use for what?
8 years.
8 years.
Okay. This is going to be for what?
6
years.
years.
Okay. You can see that Denu will be using the corporate asset more than any of them, isn't it? They will be using the corporate asset more than any of them.
Yeah.
Okay. So we cannot just stand up and say we are using their carrying value to share. If you are using it like that, you are being unfair to them. So let's share the what? The carrying value of the corporate asset based on the number of time that they are going to what? They are going to use it. So we find what we call the weighted what? Carrying value, or the weighted average carrying value. If you have 160 now, you are going to use the asset for what? 10 years. So what we do is that, okay, let's multiply 160 by 10. Let's multiply the 100 by 8. Let's multiply 120, 125 by 6 to find the weighted average what? Carrying value or number of years, anyhow you want to call it. Someone can also use the 160 and then 100 to share. That is no problem because they say the carrying value. But to have the faithful representation of everything, or the share to be fair to everybody, you have to share it based on their useful lives. So we have the carrying value of 160. This person is going to use the asset for what? 10 years. It will be using it more than other people. So we use this particular, so we find their weighted value. That will be 1,600. This will be 800. And this will be how much?
750.
Okay. So we use these values now to share. I've also said that you can use the main carry value to share. There's no problem with that. Okay, but the best one is that use their weighted average carrying value to share. Okay, so head office will be share among the three. So we put this one, the total together. What will be the total for them?
3,150.
3,150. Let's now share. Let's now share them. So the head office will be shared. The head office will be shared in a proportion. So you can put 1,600 over there. So you can put the ratio, the proportion, which will be 1,600 is to 800 is to 750. So you can share it and put the value there, because since you put a ratio there, it means that you have done the sharing already. So 1,600 divided by 3,150 times the value of the corporate asset, 84. What are we having?
562.67.
Okay, so let's make it to 2 decimal places. So we have 42.
42.67.
Okay. The second one will be what?
Let's see. 21.33.
Okay. 21.33. Second year,
Senior,
yeah.
did you say 1,000 divided by what times what? My line went.
We use the values that we have gotten. They are weighted average values. So the first one will be 1,600 divided by 3,150 multiplied by the value that we are sharing. So 800 divided by 3,150 multiplied by the value that we are sharing. 750 divided by 3,150 multiplied by the value that we are sharing. Because the corporate,
Thank you.
the head office is for all of them. So it will be shared among all of them. Okay. So what are you having?
Thank you.
The last one is what?
18.6.
Okay, 18.6.
Mm.
You have to
No,
make,
sorry.
you have to make sure that if you
It's
add all
20.
of them,
Sorry.
you have to make sure that if
Please,
you
it's
add
20.
all of them, you get the same value. So 20.0, isn't it?
Yeah.
Please,
Yes.
please, if you haven't seen this before, if you haven't seen this under impairment before, if you go try to solve it on your own because they can examine it. They are capable of everything. They are now examining what issues that are only pertaining to corporate reporting now. So if you haven't seen this before, you haven't heard it before, you have to take your time, revise it, and know how to adjust it. Let's come to the product development center. The product development center will be shared to who and who?
Yes.
Dana and Pepper.
Okay, so it will be shared to only the two of them. The third subsidiary, which is Token, is not having part of it. So that will be shared 1,600 is to what? 800. Are we okay? So let's share that.
You get 17.33.
17.33. Okay.
And VP will get
8.67.
8.67. And this person will be dash, isn't it?
Yes.
Okay. Let's now find the total carrying value of
Let's
the
add.
asset. So this is the carrying value of the asset now we have. This is the total value of the company now. So let's now find the total value of the company.
Hello, 220.
So with D is 220.
Okay, so 20. Yes, someone mentioned my name.
Yes, please, the product development, how did you get this thing?
Oh,
The 1733.
okay, we do the 1,600. The ratio will be 1,600 is to 800, which is what? 1,600 over 2,400 multiplied by the value.
Okay.
Multiplied by the 26.
Okay.
Okay.
Okay. Thank you.
Are you okay? Okay. Don't come and do 160 times 15 or no. You just use the asset. It's this asset that they will be using. So you just use the first one that we have used. Don't come and say you are using the useful life of the corporate asset. No. We use the useful life of the asset. Okay. So the second one is what?
130.
130.
Okay. So the other one is what?
145.
Okay, 145. So these are the carrying value now. These are the carrying value at the date of what? The impairment. Let's look at the recoverable amounts now. Let's now look at the recoverable amount given to us now. What is the recoverable amount now? For then who is what?
155.
January is 155.
Okay, we use the highest one. Okay, 155. So we have 155 now. Okay, the other one will be what?
115.
115.
115. Okay, this will be
169.
okay. You can see that there is no impairment over here, isn't it?
Yes.
But
Yes.
there is an impairment of 15 here, isn't it?
Linus,
Yes, please.
Linus,
Yes, please.
you see from the question, they were like, the asset is not expected to be recent. So you were like, will you, the value you use to get as the recoverable?
No, you just use the highest one. Even if they don't have any cell, the recoverable amount will be determined using the highest one. So the recoverable amount will still be determined using the highest one. Okay. Are you okay?
Okay, thank you.
Okay. So what will be the impairment loss for the
65.
65? Okay. So what will be the total impairment that will be charged to profit or loss?
80.
80. Okay. But they are saying that we should find the what? We should find the carrying value of the CGUs and their what? Their the corporate assets. Okay. How do you think the 65 impairment loss will be shared among the asset itself, the head office, and the product development for them? How are we going to share it? What are we going to use to share? What do you think?
So,
Okay.
so for example, when we take the new like this, the D, so
Okay.
when we go for their carrying value, like the main asset, that's the 160.
Okay.
Then 160 divided by the 220
Okay.
times the 65
Okay.
for the asset. Then you do the same thing for head office and products development as well.
Okay. Thank you.
You're
The,
welcome.
the impairment will be shared based on their, it's just like the normal sharing of impairments. If there's no goodwill, the impairment will not be shared based on what? Pro rata basis. So we use their existing carrying value before the impairment and now share the impairment loss. So what we are going to be having the asset itself, it will be calculated as 160 over 220 times the impairment loss of 65. That will be their portion of it. The head office will be 42.67 divided by 220 multiplied by 65. Are we okay? Then the product development for Denu. This is only Denu. Then we have 17.33 divided by 220 times 65. So can we get a share? Then we move on to the V. The V, their assets will be having 100 over 130 times 15. Okay. The head office will be having 2133 divided by 3133 divided by 130 times 15. Then the second one, the last one rather, product development will have 8.67 divided by 130 times 15. So you can just get them, then you add the total impairment for them. So what will be the impairment for the asset of those people? What will be their impairment? 160 divided by 220 times 65.
Hello there.
Yes, please.
Yeah, please, the one you just did, what are you competing for?
We are computing for their share of the impairment loss.
Share of impairment loss. Oh,
Yes,
okay.
please. So you find the share, then you subtract it from their carrying amount. So for this one, I'm having 47.27. Is that correct?
Yes, please.
Okay.
Yes, please.
Okay.
So the second one is 12.6.
12.6. Okay.
1. 6, 1. 12. Yeah.
The last one is what?
Five point. Yeah, 5.12. Yeah.
5.12.
Yes.
Okay. Let's come to the V. What is the impairment of their asset itself?
15.
I'm getting 11.54.
54. Yes.
Okay. Yeah. Sir Mohammed.
2.46.
Yes, please.
Hello. Yes,
Yes,
please.
please.
I
Yes.
went off. Yes, I went off. I was confused about this. How you had this the proportion 1,807.
The 1,000.
1,870.
Okay. 1,700 and 800 and 750.
No, the 1,600
These ones.
is to 800.
Okay. These ones. Okay. So this one was calculated as this one. We look at the carrying value. Okay. The asset, the new is going to be using I'm coming. Let me put my screen. Let me pick my screen. Please, I didn't send you. So you don't have to be making me feel bad. The way you are doing her, or like I'm feeling bad. I didn't send you. Okay. Okay. See, yeah. So what we did was the asset. It is these CGUs that are going to be using the corporate assets. So this particular person, the new over here, will be using it for 10 years, and Viepo will be using it for 8 years. Token will be using it for 6 years. Okay. If we are just sharing the 84 using their carrying value, we are going to be unfair because the new will be using the corporate asset more than any of them. So what we do is that we try to find what we call the weighted average carrying values by multiplying their carrying value by their useful life. So we do the 160 times 10, 800 multiplied by this, and this multiplied by this. Then the answer that we get is the value that we are now going to be using to apportion the carrying value of the corporate assets. So this will give us 1,600. This will give us 800. This will give us 750. And that was how can we have the ratio of 1,600 is to 800 is to 750. Are we okay now? All right.
Sure.
Okay.
Thank you.
All right. So let's now look at the. So what will be the share of the head office under the V?
$2.46.
2.46. Okay. And the last one, which is the department, will be 8.67 divided by 130 times 15.
1.
It's 1.
Yeah.
Okay. So I hope we can now determine the what? The carrying values, isn't it? Can we now determine the carrying value after the impairments? The asset itself will reduce by
Yes.
47.27. I hope this will be
So what we just did is what?
what we did is the share of the impairments, the 65. Okay. So this out of this particular 65, the asset itself is taking what? 47.27. So what you do is you now count to the carrying value of the asset or carrying value of the CGUs. Okay. So you have the D, the V, and the T. So you look at their carrying value before the impairment. It is 160, it was 100, and it was 125. Am I correct? Okay. So their impairment is now what? Let's now look at the impairment loss. So the impairment loss for them will be 47.27 here. Then this was 11.54. Okay, there was no impairment in this one. So this will now give you a carrying value after the impairment. This will now give you a carrying value after the impairment. Then you come to the corporate assets. The corporate assets, you now have the head office and also the product development. You have their carrying value before the impairment. I'm sure that was 84 and that was 26. What is their total impairment now? You see that for the head office, they are impairing by 12.21 over here. And under this place, they are impairing by 2.46. Put the two together. So their impairments will be their respective impairments under all of them. So 2.46 plus 12.61. 12.61. So you put it over there for the head office. The same thing that you are going to be doing for the production department. They have 5.12 of the share under the V, and this will be so this will be, we have one under that one. So that will be 6.12. Then we do the subtraction over there and put it over there. That is all about this particular one, which they will say that you should use the reasonable as a reasonable proportion of their carrying value. That's how you go about it. Okay, let's count to the B side. The B side is where the allocation cannot be done. We cannot allocate the carrying value of the corporate asset to what? To the CGUs. How do we test for the impairments? The first thing that is that you test for impairment on the CGUs first. The first one you test for the what? CGUs first. So we are going to carry out impairment on the individual CGUs first without the corporate assets. That is the first step. The second step is that you test for what? Any of the CGUs that any CGUs that a specific corporate asset can be allocated to. Then the last one is you test for the company as a whole. Test for the company. So you test for the company as a whole. So this one is very simple. This is very simple as compared to the other ones. It's very simple as compared to the sharing. Okay. So what we do now is that we are going to carry, the first step is that let's carry impairment on the what? On the individual CGUs. We're having 160, 100, and 125. What is their respective what? Recoverable amount. We do it as if the recoverable amount was not given in relation to the corporate asset. That's what we do. Okay. So what is their respective recoverable amount and which of them is impairing? So let's now look for the testing for each of them, which we call the stage one. Stage one. So we have the DENU, JEPE, and T. What is their carrying value before the impairment? 160 against what? 100 against 125. What is their recoverable amount? What is the recoverable amount given to?
155 for Denu.
Okay. 155. 155.
Then 115
115. And
169.
169. Which of these assets is now impairing?
The first one.
Then
Okay.
T.
Okay.
Then
So there is an impairment of what? 5 on what? The new Olin, isn't it?
Denu.
Okay.
Yeah.
So we move on to stage 2. The stage 2 is we now test for the CGUs that are having a specific what, or that a corporate asset can support. Okay. We now see that Denu and Viepe are being supported by what? The product development, isn't it? So we carry out the impairment test on them. So let's look at what is the carrying value of Denu now after the first stage. Would it-
155.
155. What is the carrying value of V after the first stage? The carrying value will still be 100, isn't it?
Yes.
Okay. So let's add the 2. It will be 255, isn't it? Then we now add the product development. The product development is what? Is it 26? Someone to confirm that for me. Okay, the product development is what? Is 26.
26.
So what's supposed to be the total value of these two companies, these two car generating units?
281.
Okay, 281. Let's now look at their recoverable amounts. The recoverable amount will be relating to only the two subsidiaries. What is their recoverable amount?
There. Hello, sir.
Yes, please.
Please, this is 2. The 155.
Yes, please.
Is it for Denu?
Yeah, it's for Denu because there is an impairment of 160. So their carrying value will now be the recoverable amount.
Oh, okay.
So you don't use the 160. We are using the 100 because there was no impairment on the upper. So the assets will still be carried at the carrying value. Are we okay?
Oh, okay.
All right. So let's now look at their recoverable amounts now. What will be their recoverable amount? It will be what? 155 plus what?
115.
Okay.
270.
Okay. So that will be 155 plus 115. That will be 270, isn't it?
Yep.
Okay. So what will be the impairment?
Will be 11.
So you see, this particular 11, you can still decide to apportion it among these people, but no, just take it to the what? To the corporate assets. Because before this one, there was no impairment. You can see that before this, our carrying value will be 270 if we have only the two assets to be 255 against 270. There will not be any impairment. But since we are adding the corporate assets, there is an impairment of 11 now. So just get the 11 to the corporate asset. Someone can also say that, okay, after in the stage 2, part of the 155 has impaired, part of the 100 has impaired. Then they will now share the 11 as 155 divided by 281 times 11. No, my brother, you are wasting your time. Just attribute the impairment loss to the corporate asset. So this will take what? 11 out of the, we are going to be taking 11 out of the 26. So this will now be remaining what? 15. Let's count to stage 3. Stage 3, you will now carry out the impairments for the company as a whole. Let's count to stage 2. What is the carrying value? This one you can take it straightforward from this particular side. What will be the carrying value now? From stage 2, what is the carrying value? It will be 155 plus 100 plus 15. It's the same as the 270 here. That's all. Because it is 281, but there will be an impairment of 11 from it. So that will be 270. Okay. Then we now add the head office to it. That will be 84. What is the head office value? What will be the total value rather?
354.
Okay, 354. So let's now look at the recoverable amount for the total company. Sorry. We are doing total company, so the second one's supposed to come. The third one's supposed to come, sorry. Okay. Token's supposed to come. The carrying value of token is what? 125, isn't it? So we are doing it for the whole company. So that would be 125. So if we add, we are going to be having a different figure. So we are doing it for the whole company.
Where is the 15 coming from? The 15.
The 15 is relating to the product development. It is 26. There is an impairment of 11.
But then why didn't you use the head office?
Head office is
Senior and the 26 too.
the 125. No, the stage 3 means that we are going to find the carrying value for the company as a whole. So we are adding the head office over here. You can see the head office is the whole that I'm writing over here. So I'll add it and get the final answer here. Should we take it again?
Yes, take it again, please.
Linus.
Yes, please.
So when you bring the 15, maybe after doing the carrying value 155 plus the 100 plus the 125, and you bring the 15 to the next, maybe using it as the PD, will it be wrong than adding it to the first one?
No, you will not be wrong. Okay. So what I want to do is you can just ask yourself, what is the carrying value after the stage 2? You can see that after the stage 2, after the second impairment, your carrying value will now be 270 because it is 281, but the recoverable amount is 270. So there is an impairment of 11. So the asset will now be brought down to what? To the recoverable amount. So this will now be 270. You can decide not to do anything, not even to add, because this will now be 270. That is the value of the asset after the second stage. Okay, so that will be 270. All right. Then what you do now is you bring the T, the carrying value of T, that will be 125. Then you now bring the head office of 84. So let's put all of them together and see what we are going to be having.
479.
So in the stage 2,
Yes.
why didn't we add the head office straight away like we did for the production department?
No, the head office is for the three, is used by the three CGUs. Okay, but the production department is used by only 2.
Oh, okay.
So we do for the first 2 first. So if we are considering only the production department, what will be the value of the CGUs? So you do it every stage to know the impairment. If you put all of them together, you might not be having the portion of the impairment that is relating to the individual corporate asset. Although on total basis, you'll be getting the total impairment, but allocation, you will not be getting the same figure. So you do it stage by stage to know the impairment at each stage. All right. So let's now look at the recoverable amount for them. You see that the recoverable amount will now be what? What will be the recoverable amount? It will be 155 plus what? 115.
115.
Okay. Plus 169. Okay. Are we okay with the recoverable amount?
No.
Is the recoverable amount correct?
Senior, is it because the new was impaired? That's why we're using a 155 instead of 160.
No, the asset will be, the carrying value will now be brought to the recoverable amount. So we can't use the initial carrying value again because it has been impaired. So the carrying value now will just be the recoverable amount. Okay. We are still using the 100 and those ones because those assets has not impaired. Those assets has not impaired. Are we okay? Okay. Let's look at the total recoverable amounts.
439.
439. Okay. The difference is what?
40.
Okay. This 40 will be attributable to only the head office. That's all. That is how you go about it. It's very simple. Okay.
Are you sure?
Yes, let's look at the total impairments. Okay. So the total impairment will now be the 5 plus 11 plus 40. So that will give us 56, I'm sure. Okay. So you can see that if your allocation is not down to the individual CGUs, you are having impairment of 56 against the what? The 80 that we had first. So maybe they can ask you to advise whether they should allocate or not. They should not allocate based on the okay. Okay, seniors, let's look at it's very simple. It's not anything because you haven't seen it before. It's very simple. Okay. Okay, the two is not
Linus,
yes, please.
please go to the other sheet. The stage 2, the B.
Okay.
Hey. Yeah. Okay, that's okay.
Okay. So I would like to solve the 2, but the 2 is not anything. The 2 is not anything. Okay. They say you should prepare this one based on the following assumptions. The company has no plan to sell. If the company has no plan to sell, your recoverable amount will still be determined as the higher of any of the 2. So you just determine your recoverable amount over here. The higher amount over here is 568. Then what you do is add your carrying value before the impairment. So put all your carrying values together over here. Put them together. Then you subtract, you compare with the 568. What are we having? 144 plus 96 plus 230 plus 70 plus 66 plus 96. Okay. Minus 568. I'm having 134 as the impairment. Is that correct?
Hey. Minus what?
Okay. The recoverable amount is 568 because it's
568.
Yeah.
Okay.
Yeah, correct. 134.
That's correct.
Okay. 134. Okay, let's now
Yes.
let's now come and look at the fair value less cost to sell for each of these ones. Okay.
Okay.
So you determine the recoverable amount for the individual assets. So what is the recoverable amount for the building?
140.
140.
But the actual value was what? 144, isn't it?
Yes.
It means that the 4 out of the impairments will be relating to what? The building. So we only what? Reduce the what? The impairment to what? To the recoverable amount of the assets. So the recoverable amount for individual assets, building will be having 140 and their carrying value is what? 144. It means that it has reduced by 4. So 4 out of the impairment will be for the building. But the building is having revaluation surplus. So this will be taken to revaluation surplus to reduce it to 8. Okay, because the impairment is relating to assets that was revalued before. So we only take 4 out of the impairment over here. Let's count to the equipment. Let's count to the equipment. What is the recoverable amount for? Yes, please.
Is it after you share the impairment loss
68.
and
No,
maybe
you don't share. This is how you are going. You don't have to do that prorating sharing. No, you give it to them based on their value given to you. They will give you their recoverable amount. You can only reduce the impairment to the recoverable amount. That is it. So you don't have to say that you are doing 144 divided by this. No. Unless you are not giving a recoverable amount, that's why we just share based on their carrying value. When you look at the recoverable amount, this has reduced by 4. So it means that 130 will be remaining. Let's look at the equipment. What is the recoverable amount for the equipment?
68.
Okay. But their carrying value was what?
96.
So it has reduced by what?
28.
So 28 of the impairment will be for what?
This whole thing is confusing.
You see, the impairment that you have been doing is where you will be giving only carrying value. Okay, you'll be giving only carrying value. Then this 134 will be assumed that it will be share on 144, 96, 230, 70, and goodwill will take what? 66 out of that one. Okay, you assume that goodwill
Yes.
will take that particular. It's based on the carrying value. But this one, they have given the what? The recoverable amount yourself. So if the asset is 144 and they are saying that the recoverable amount is 140, it means that the value has reduced by only 4. So only 4 of the depreciation should be, only 4 of the impairment should be given to that particular asset. You can't reduce more than what? 140. That is it. All right. So before we go, the goodwill is supposed to take all the impairments first. Let's apportion to goodwill before we start sharing. Okay.
Okay.
Okay. So goodwill, I didn't see the goodwill. Goodwill should take all the impairment of 66.
66.
Okay. So what are we going to be having after the goodwill?
68.
Okay. So this 68 now, the building will be taking 4. Okay. The building will be taking 4 and equipment will be taking 28, isn't it?
Okay.
Okay. Let's now count to the machinery. What is the recoverable amount for the machinery?
207.
We use the highest one.
207. Yes.
Okay. The carrying value was what?
230.
Okay. What is the reduction there?
23.
23.
Okay. If we are reducing, we should be looking at if it is more or not. So 23. Let's add it and see whether it's more than the 68.
So it's like 26 or so. 36.
I'm having 13 left.
Yes.
It's left with 13, isn't it?
Yes.
Okay. Which asset over here you think that you can give the 13 to?
The license.
The license.
We give the 13 to the license because the inventory has not impaired.
Yes.
The inventory has not impaired. That's how you go about it. Okay. This is on the first assumption. The second assumption is.
So,
yeah, you wanted to say something?
Please, you continue.
Okay. That is based on the first assumption. The second assumption is that the company has a plan to sell the asset in the future. In that case, your recoverable amount should be only the what? The net realizable value, which is the fair value less cost to sell.
Okay.
Okay. So you now have 55 against the what? The value that we have over here. So you now determine your impairment. Goodwill will take the first one, and you can decide to share it the way we share it, or you can decide to now prorate it. There's no problem with that one, because under the non-current head for sale, you can go ahead to what? To just share the impairment to them after the goodwill. But you can still use how we share it. There's no problem with that one. They can mark that T. Okay.
Linus.
Yes, please.
So meaning this one, you compare the 555 to the current value of the assets.
Yes, please. So it will be seen as head for sale. So you use only the net realizable value. The recoverable amount will be true sale. So you use the what? The net realizable value of 55 against the current carrying value. Then the impairment over there, goodwill should take the first one. You can decide to share the remaining one based on how we share this one, or you can just share it based on their carrying value. There is no problem with that one if you are doing the head for sale. But it's only goodwill that you have to. It's only impairment that you have to make sure that you don't reduce the recoverable amount, or you don't reduce the impairments more than the recoverable amount given to you. Okay. Let me.
Linus.
Yes, please.
Please say you had impairment of how much?
If I'm using the second one.
Yes.
No, I didn't do it though. So you have to do it yourself.
Oh, okay. You were just explaining. Okay,
yeah.
All right.
So let's try that one because the current impairment is 134. So 5 is 68 minus 5. The difference is 1. So plus this one. I'm having 147.
147, yes.
Okay. So goodwill will take 66 out of that.
Okay.
Okay. So the remaining one, you can just decide to go ahead and share it the way we share it over here. Or you can share the remaining one based on the carrying value of the asset that are likely to impair, which will be these ones. Okay. So you can go ahead to share like that. For the current asset so you can share like that. Or you can still restrict it to their recoverable amount. There is no problem with that. But the recoverable amount that you are going to be using will be fair value, less cost to sell. Because we are going to sell the asset. So the value in use will be what? Irrelevant over here.
Okay.
For you to avoid that problem, just share based on the carrying value. That's all. Just share the impairment based on the carrying value. They will still mark you for the head for sale. We just do the goodwill, then we share the remaining one based on their carrying value. If you don't even share based on the net realizable value, that they will not punish you for that particular one. It is only the
so that using the pro rate, right?
Yes, please.
The pro rata basis.
Yes, please. For the impairment itself, you can't reduce more than the recoverable amount. It's very important. Okay. Let's try the question. Okay, question 3, I've solved that one during the normal class. Let's try the question 4 before we move on to another one. Let's try the question 4. It's also an interesting one, but very simple. Okay. The impairment they have been examining what? Impairment of a subsidiary. And this is an impairment of subsidiary. Let's look at it.
On January 1, 2008, Esba Holding Limited, dealing in textiles goods, acquired 90% ownership interest in Sama Limited SL, a gaining company, against cash payment of 450 million when the retained earnings of SL was 250 million. At the date of acquisition, SL's net identifiable asset had a book value of 350 million and fair value of 400 million. The fair value increase is in respect of a plant which has a remaining useful life of 5 years at acquisition. It is the policy of the company to measure non-controlling interest at their proportionate share of SL's net identifiable asset. During the year ended 31 December 2008, SL incurred a net loss of 150 million. The impairment testing exercise carried out at the end of the year by a firm of consultants showed that the recoverable amount of SL business is 200 million. However, the board of directors is inclined to take a second opinion as they estimate that the recoverable amount is 390 million. The subsidiary's net asset, excluding any fair value adjustment and goodwill at current reporting date, is provided below.
Okay.
Required. Based on the two valuations, compute the amount to be compared, the amount to be reported in the consolidated statement of financial position as at 31st December 2019, respect of goodwill, net identifiable asset, and non-controlling interest. Hey, Consul.
Very interesting. And this is how they are going to examine you on the impairment of subsidiary. Okay. What do we have to do? You see, you can also answer this question using the net asset table. It's very simple. Or you can also use it on a different way. Okay. How much are they paying for the how much are they paying for the 90%? How much are they paying?
450 million.
Okay. And the net asset at that date was what? It's 400, isn't it?
It is 400 fair value, yeah.
Okay, you use
Fair value.
the fair value, which is 400.
Yeah, 400.
Okay. Okay. So what you have to do is that first of all, you have to ask yourself whether there will be a goodwill on this particular acquisition. So you look at the goodwill calculation first. So the goodwill calculation will be the purchase consideration. Purchase consideration of 450. Then you let the net assets. The net asset will be, don't go and be adding NCI. Okay, that will be 0.9 times what? 400. Are we okay with 0.9? Are we okay with the 0.9?
Yes, sir.
They are using
Yes.
proportionate
Because
method.
it's proportionate.
Okay. So you have goodwill of what?
90.
Okay. Someone can also prepare this one like this. Someone can also use net asset table. Okay. Someone
Why
can.
not? Why
Yes.
didn't we add the NCI? The NCI, why didn't we add it?
Okay. Because I don't want to waste time.
Oh, okay.
I'm in the exam hall, so I'm answering the question in the exam hall. Are you okay? But you can add the NCI. Okay, there's no problem. So at acquisition and also at reporting. Okay, so someone can just do share capital. What is the value of the share capital from what we are given? Will the share capital be 100? Look at it again. The retained earnings of the company at acquisition is what? 250, isn't it? Okay. And the identifiable net asset had a book value of what? 350, isn't it? Okay.
Yes.
The book value will be of only the share capital and then what? The retained earnings. That is the net asset. So if the retained earnings is 250 and the net asset is what? 350, it means that the share capital is 100. Are we okay? Okay. So you have the retained earnings of 250. What will be the retained earnings at reporting? What will be the retained earnings at reporting? Read up to the end. During the year, the company made a loss of what?
Net loss of 150.
Okay, so what will be the retained earnings at reporting?
It will be
100.
To be 100. Yes, the loss will reduce the figure at the end, so that will be 100. Okay, we have a fair value adjustment, which is plant. Okay, the plant will be what? Will be 50 at acquisition. But at reporting, what will be the plant value? The second one at reporting, what will be the value of the plant? Senior, what will be the carrying value of the plant at the reporting? At acquisition is 50, but this has a remaining useful life of 5 years, at acquisition. Yes, ma'am. Yeah.
Remaining useful life. Where is that one?
Okay, the fair value increase is in respect of a plant which has a remaining useful life of 5
Remaining
years
useful
at acquisition.
Oh, okay.
So what will be the carrying value at reporting? Are we seeing what I'm saying? When was the acquisition date?
40.
That will be 40. It will depreciate by 10 because acquisition, so that will be 40. So we can have,
How did you get the 50? The 50.
is that?
The 50 at the acquisition.
Yes, please.
Like, how did you get the 50?
It is the difference between the book value and then the fair value. At the date of acquisition, the net asset had a book value of 350 and a fair value of 400. The fair value increase is in respect of a plant which has a remaining useful life of 5 years at acquisition.
Okay.
All right. So let's now look at the net assets now. Okay. So this will be 240. Okay. So this will be 400 and this is 240. We don't have any issue with anything over there. But what are we going to look at? What are we going to look at now? Let's look at the total value of the company because we want to know the impairments. So the total value will give us the net asset before any adjustment on acquisition. That will be 240. Then we add what? Goodwill. Am I correct? We add a goodwill of 90. That will give us 330. That is the total value of the company. Then we now compare with the recoverable amounts under the first situation. The recoverable amount is 200. There will be an impairment of 130. Okay. Let me also show you how you can calculate the net assets here using the figures given to you. Okay. They say that the subsidiary's net asset, excluding any fair value adjustments and goodwill at current reporting date, is provided below. So without the goodwill and the fair value adjustment, what is the value of our net assets at reporting?
200. 200.
That would be 200. Okay. But we want to know the total value of the company. It means that we have to come and add the fair value adjustment because the fair value adjustment will reduce by 10. We are going to depreciate it by 10 before the year will end. So that will give us 40 plus the goodwill. What will be the total?
330.
Okay. So you can also use this side to get the what? The 330. That is also correct. Let's come to the impairment over here. Under the first situation, our impairment is what? 130. Okay. This 130 now, how are we going to share it? Goodwill will take how much? How much is goodwill taking?
90.
Okay.
90.
Goodwill will take 90. Okay. Goodwill will take 90. Okay. And if goodwill is taking 90, the remaining what? What will be the remaining one? Would that be 40?
Yes.
Okay. How do we share the 40 now? Look at the inventory value.
Inventory will take 2.
Inventory will take 2. That is very important. Okay. Inventory will take 2. Okay. Then the remaining what? 38 will now be shared what?
Pro rata.
Okay. We now pro rata the remaining 38. So that will be land and building. Land and building will be having 100 over 160 times 38. What are we having? And the equipment will be having 60 over 160 times 38. So let's put the two together and have our 100 divided by 160 times 38. I'm having 23.75. Okay. Minus 38. And we have 14.25. You add all, you will be having 130. Okay. Let's look at the second situation. The second situation, the recoverable amount is 390. Is there any impairment? The second situation, the recoverable amount is 390. Is there any impairment?
No.
No, there is no impairment. Are you okay?
Where's the 390?
Okay. They say, however, the board of directors is inclined to take a second opinion as they estimate that the recoverable amount is 390 million. So based on each of the two valuations, we are doing this. Okay. So what are they asking us? They are asking us to find the carrying value. So under goodwill, are we going to be recognizing anything for goodwill for this year? Will goodwill be having anything? Will there be any value for goodwill?
No.
No. Under the first situation, there will not be any goodwill. But under the second situation, what will happen? Goodwill will still be 90, isn't it?
Yes.
Okay. Let's count to net identifiable assets. Under the first situation, what will happen? Under the first situation, we are going to be having 100 plus 60 plus 40 plus 40 minus 40. Okay, we are going to be having 200 because we'll be adding the fair value adjustment of 40 to this one and the impairment also of 40. So our net asset will now be 200 again because this one is excluding the what? The fair value adjustment. The fair value adjustment at reporting is 40 and the impairment relating to the first situation is still what? 40. So it will still be shown at 200. But under the second situation, our asset will still be 240 because there will not be any impairment. We come and add the fair value adjustment over there. We add our fair value adjustment over there. Let's count to the non-controlling interest. Let's determine the non-controlling interest in the first place. So the non-controlling interest, which is the NCI, the value at acquisition. The value at acquisition. The fair value at acquisition will be 0.1 times 400. That will give us 40. Okay. That will be 40. So what is going to happen here? That will be 40. What is going to increase the NCI and what is going to reduce it?
Goodwill.
The goodwill, we are using proportionate, so goodwill will not come here. The impairment of the goodwill will be for only the parents. It is the parent that is going to suffer the impairment of the goodwill. Okay. But the impairment of the other assets, which is 40, will be shared among the parents and then the NCI. And also the what? The loss. The loss of 150. Okay, the NCI will have, okay, so NCI will now have so the NCI will now be, we have the share of loss. The share of loss will now be, the share of loss will now be 0.1 multiplied by 150, and the share of impairment on the asset, not the goodwill, because the asset that is impairing is for the subsidiary, and the NCI is also part of the owners of the subsidiary. So share of impairment will be 0.1 times 40. So that is what we are going to be having. This will be 15, then minus what? 4. Okay. Okay. I wanted to make a certain assumption. You can see that if you look over here, the loss is 160, isn't it?
Yes.
Okay. The loss is 160, but I'm assuming that they have already adjusted the fair value adjustment before they have 150. So that's why I'm sharing the 150 to them. Okay. So that is about this particular one. But if you come to the NCA under the second situation, there will not be any impairments, but there will be the share of the loss of 15. That is about that particular one. Let's take revenue. Let's take a question on revenue so that we know that at least we have done 2 standards today. Then tomorrow, I'm thinking about Saturday dawn, or maybe we don't have class on Sunday. We can use 6 p.m., 6:30 p.m. on Sunday in the
Oh,
evening.
learn on Sunday, yeah. Sunday, yeah.
Okay, let's use dawn. Let's use Sunday dawn. Okay, to complete the standards, because we have to do more on the standards. Okay, that is the main problem. So let's take this question on the revenue, the first question on revenue. Then we know that, okay, at least we are done with the 2 standards for today. Or we just start it tomorrow.
Oh, let's just kill it.
Yes, yes.
Okay, let's kill it then. Okay.
Yeah.
Okay. Sina, are you there?
Senior.
Okay.
That
Financial
family.
statement of Hikmat Limited for the year ended 31 December 2019 are under preparation. In this respect, the following matter is under consideration. On 1 September 2019, HL entered into a contract to develop a software for Dr. Limited deal for 150 million. He ascertained that the promised development of software is a single performance obligation satisfied over time. The terms of the contract include a penalty of 14 million if the development of software is not completed before 29 February 2020. At the inception of the contract, HL determined that the expected cost of completing the contract would be 90 million, and the software development would be completed before 29 February 2020. Till 31 December 2019, HL incurred cost of 67.5 million, as the original contract was 75% complete. HL has recognized revenue and profit of 112.5 million and 45 million respectively in the draft financial statement. However, HL and DL have amended the contract on 31 December 2019. As a result, the consideration and expected cost increased by 70 million Ghana cedi and 40 million respectively. The allowable time for completion without penalty is increased by 1 month. HL now expect that the development of software would not be completed by 31 March 2020. The additional work is not distinct from services under original contract. No adjustment has been made in HL's financial statement in respect of the amendment in the contract. Required. Discuss how the above transaction should be dealt with in HL's financial statement. 4.
Okay. For which year?
The year ended 31 December 2019. Show all calculations whenever possible.
Okay. This thing is not difficult though. It's not difficult.
And there's plenty like that.
Yeah, please. Okay. It's not anything. It's not anything. Okay. First of all, what we have to know is that you have to know how revenue should be recognized. And you have to know the type of what contract is this one. You can see that this is likely like a construction contract, isn't it? Or a manufacturing contract. Okay. They are going to be developing the software. So the software will be in processes. So as soon as they are done with this particular process, they can recognize revenue to the completion. So this is going to be a revenue recognized over over a point in time. Okay. So let's now look at what they are saying. Let's now look at some of the things and we take them one by one. That is all. Okay. What is the total contract price?
$150 million.
Okay. The total contract price is 150 million. The question has even said that they are going to be doing this they are going to be doing this. They are going to ascertain that the promised development of software is single performance obligation satisfied over time. They have even
over time.
Yes, they have even stated that particular one for you. So if it is over time, the revenue recognition has to be based on what? The work of completion or percentage of what? Completion, which you can use the input method or the output method. Okay. The terms of the contract include a penalty of 40 million if the development of software is not completed before 29 February 2020. At the inception of the contract, HR determined that the expected cost of completing the contract will be what? 90 million. And the software development will be completed before what? 29 February 2020. This 14 million, what is it? Should we make a provision for it? Or which type of
Yes.
liability is that?
Contingent.
That is a contingent liability. So the occurrence base is based on what? The performance of the contract.
Yeah.
So since we don't know, but they are saying that okay, the people are not likely to what? To finish the contract.
To meet.
Yeah, to meet that particular one. Yes, they have a reliable estimate, but this is still something that it can happen or it cannot happen. Okay, so we come to that one later. Okay, so they are saying that the inception of the contract, HR determined this and this. HR determined that the expected cost of completing the contract will be what? 90 million. So the total cost of completing the contract is what? 90 million, isn't it?
90 million, yes.
What will be the profit on this particular contract? What will be the overall
60
profit?
million.
Okay, so let's count to the contract price. The contract price is 150 million. So the total cost of completion, the total cost is 90 million. So the total profit is 60 million. Okay, let's now move on to what again? Okay, till 31 December 2019, incurred cost of 67.5 million as the original contract was 75% complete. Check something. Apply the 67.5. Find the percentage of the 67.5 of 90 and see whether you get 75. If that is the case, then that means they are using input method. Okay. So 67.5 divided by.
Yeah, that's 75.
Okay, that will be 75. So they are using input method. Okay. So it means that we have completed what? So the percentage of completion, sometimes the question will ask you to calculate it yourself, but this one they have calculated it, that is 75%. So if you complete all the work, we are going to recognize a profit of what? 60.
60.
But we complete only 75. So what will be the profit that will be recognizing?
45.
Okay, that will be 45. That will be 60 times the 75. Okay, so we have, that will be 0.75 times 60. That will give us 45. Okay, this is just the profit. Let's look at the revenue that will be recognizing. So the revenue will be recognized based on the completion. So we have 0.75 times the 150. What is the revenue that we're supposed to recognize?
112.5.
Okay, 112.5. So the company will recognize revenue of this one in their profit or loss. Okay, and the cost of sales will always be, if you are using input method, it will always be the cost up to date. So that will be 0.75 times the total cost of 90. Okay, so if you complete all the work, the cost is 90. So this will be 67.5. So the profit can still be the revenue minus the cost, which will be 45. Okay. So this is what they have done. That's what they are telling you now. Okay.
67.5.
Yeah, it's 67.5.
67.5.
It's 67.5.
Hello, there.
Yes, please. Please, I can hear you. Okay. So you can see that that is what they have done. So as the original contract was 75, the company recognized revenue and profit of what? 112.5 million and 45 million respectively in the draft financial statements. Did the company receive any amount from the people? Is there any amount received? Is there any amount?
No.
Okay. So they will be having a contract asset of what? Because they are going to be billing the people the 112.5. So they'll be having a contract asset of 112.5. Because the cost that we get on the contract is 67.5. The profit on it is what? 45 million. So
45.
if we are selling to you, it will be 112.5. They will have a contract asset on it. Let's look at the next thing. However, HR
Linus,
yeah, senior.
so if they had given a deposit, if they had made a deposit, we'll take it out of the contract asset.
Exactly. We take it from the revenue and now have the contract assets. Okay. So the contract asset will always be calculated like this. The cost up to this or the cost to date, which is 67.5, then you add a profit to it. So that will be 45 million. Then you will ask yourself, is there any cash received? Then you take the cash received from it, maybe 40. And the remaining one will be the what? Will be the contract assets. Okay. All right. So let's now come here. They will have a contract asset of 11.25. Let's move on. However, HL and DL have amended the contract on 31 December 2019. As a result, the consideration and the expected cost increased by 70 million and 40 million respectively. The allowable time for completion without penalty is increased by 1 month only. And HR now estimates that the development of software will not be completed by 31 March 2020. The additional work is not distinct from service under the original contract. No adjustment has been made in HR financial statement in respect of the amendment in the contract. The amendment is it relating to a different contract?
No.
Okay. What if it is relating to a different contract? How do we treat it?
You treat it as a different contract on its own.
Exactly. It will be treated as a different contract on each one. But this particular amendment is relating to what? To the existing contract. It means that we need to do additional work and our estimation of work complete supposed not to be 75. It's supposed to be a different figure. So we have to now remeasure our percentage of completion because this is now additional work to the work. So the 75 will not be the completion now. So what will happen now is that our purchase price, our contract price will now increase to 150 plus what, 70. Are we okay?
Yes.
That will be 220. Okay. Our cost to complete now will be what? Will be 90 plus
40.
Plus 40. And that will be 130, isn't it?
130.
Okay.
Yes.
It means that the work will increase more than the original work. So our percentage of completion should not be 75. We have to re-estimate the what? The percentage of completion to recognize the revenue accordingly. That is the only thing that we are going to do here. Okay.
Okay.
So let's re-estimate. Let's re-estimate the. So let's re-estimate. Okay. So we estimate the cost of completion, the percentage of completion. Okay. So the percentage of completion, we are still using the input method. Okay. The percentage of completion, this will now be the cost incurred to date, 67.5, divided by now, the new cost will now be what? 130, isn't it?
130.
Okay. Multiply by 100. What will be our cost of completion?
51.9.
It will be
51.9.
okay.
So let's say 52.
Okay, 52%. So if it is 52%, revenue that we should recognize to be only 52%. Okay.
Okay.
So the revenue should be only 52 of the completion. So we have 0.52 multiplied by the total revenue now, which will be the 150 plus. That will give us 220, isn't it?
Yes.
Okay. How much are we having?
114.4.
Okay. 114.4. Okay. Let's now look at our cost. What will be our cost of sales now? Our cost of sale will still be the 67.5 because we are using input method. What will now be our profits? What will now be our profits?
Sorry, Lennox.
Yes, please.
46.9.
Yes, yeah.
What it means is that the cost incurred to date has not changed.
Yes, it has not changed. The cost incurred to date will still be the same cost. Okay. So that will be 46.9. Okay. Senior, did you get this thing? The cost incurred to date has not changed.
I'm okay, yes.
Okay. Okay. The cost incurred to date has not changed. And
Yeah,
okay.
Senior,
Yes, please.
are we solving question one?
Yes, we are solving question one.
Oh, well, seems I'm confused. Okay, thank you.
No.
Okay.
Why you're at?
So let's now do what was the revenue recognized? The revenue recognized first was what? 112.5.
12.5.
Okay. What's supposed to be the actual revenue? What's
114.4.
So what is the difference? What is the difference?
1.9.
1 point.
Yeah, 1.9.
Okay. So that 1 point. Now what will happen is that the only entry that you do is that you debit your contract assets with the 1.9, then you credit your revenue because the revenue will be increasing with 1.9. Okay, let's now tackle the provision.
Yeah.
Yes, please.
Come again on how you got the 1.9.
Or the 1.9 is the difference between this one. The difference between the first revenue that we recognize. Okay. The first revenue we recognize is what? 112.5. Okay. And this one will be, the new one is 114.4. 114.4. Okay. And let's come to the provision now. Let's come to the provision now. Let's come to the provision. Okay. So let's come to the provision of 14. The penalty of 14. What is happening? The company is now certain that this particular, the work cannot be completed before the date because they have given them 1 month what allowance. So it means that the work should be completed maybe somewhere at the end of March. But they are saying that, however, HNI expect that development of software will not be completed by 31 March 2020. Will not be completed by 21 March what? 31 March 2020. What does it mean?
Meaning it is highly possible that they will meet the deadline, so they will pay the penalty.
Okay. Okay. So if you are paying the penalty will be paid out of what? The revenue, isn't it?
Yes.
Okay. So someone can say that the actual selling price now, someone can say that the actual selling price for this particular item should have been 220 minus the 14 because we'll be paying a penalty of 14. Okay, someone can assume like that. Okay, so the actual selling price will now be 206. Then the person will use the what? The 206 for the contract price. Okay. Another way of going about this particular one is that, okay, the penalty should be paid based on the cost of completion, based on the percentage of completion. Okay. So the penalty will be paid based on the what? On the percentage of completion, because we can only estimate the completion based on, or if we are able to finish the work early, it is the completion that you are going to be using to see whether, okay, we'll be able to complete this work or not. So someone can recognize this particular provision based on what? On the completion, because it's based on how fast the work is being completed. So the person can say that, okay, we have done 52% of the work. So since we are not sure 52 is done, let's now make the provision for only 52% of this particular work. Someone can also do it like that. Or you can subtract the 14 from that particular figure. But since we didn't subtract the 14 from 220, it means that we can recognize the provision based on the completion. So 0.52 times the 14. Or even if we want to terminate the contract today, it means that we are going to be paying maybe at least 52% of the revenue, because we are only getting 52% of the revenue. So if you want to pay penalty, maybe the penalty have to be equivalent to the revenue that we are getting. So let's find 52% of that particular figure and see. So,
Sir, please, are you working? Because I can't see the board.
It's your phone. Because
Hey, cover.
So the penalty will be 0.52 times what? 14 million. I'm getting something like
7.28.
Okay. So it means that this is a revenue, this is expense, so 1.9. I'm having 5.38. Okay.
Yeah.
Yes, please.
Yeah, please. That CA at the top, is it
Contract asset. Contract asset.
Contract asset. Oh,
Yes.
okay.
Okay. So that would be a contract asset. Okay. So the company will be they will be making a provision for a penalty of 7.28. And the revenue will increase by 1.9. At the end of the day, they are going to be reducing their profit by 1.38. That is all. The penalty is based on the completion of the work. So either you subtract the 14 from the contract price, or you account for the provision based on the what? On the completion of the work. Okay.
Hello, line.
Yeah, senior, you can talk now.
Uh-huh.
Okay.
But the penalty,
Yes, please.
even as soon as you let me see, as soon as you delay by a month or even a day, I think you are going to pay the entire 14 million.
Okay. The assumption is that the penalty has been factored into the transaction price. Okay.
Okay.
The penalty has been factored into the transaction price. So if you are paying the penalty, then it means that the penalty should be subtracted from what? The 220.
The contract sum.
Yes, please. But since we didn't subtract it, it means that we should also make provision, or we should also pay the penalty based on the completion.
Oh, okay.
Okay. So we know that the work will not be completed within that period. Okay. But we have done 52% of it already. So we can assure you that since the work will not be done, let's pay but in actual sense, the price should be taken from the 220. But it is just
yes, the 14.
For the 220, so that we apply the 52% on it. Okay.
Okay.
Okay. All right.
Thank you.
Okay. So my battery is down, and if we don't have any issue, we'll continue with the standards tomorrow again. All right. So seniors.
Tomorrow, same time.
Yes, 6:30 to the same time.
Okay.
All right. So thank you all for coming. I will see you guys.